We're in that moment where we see downside risks to the economy.
It's problematic that inflation has been stuck at 3%.
We should be very careful about cutting into higher inflation.
The CPI report probably is going to be using more estimated results than normal. This data may not be as reliable.
The Fed is going to cut almost regardless of what inflation print that we get.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, it's CPI day. Investors bracing for the delayed September inflation report as economists are looking for signs of tariff pass-through just 1 week before the Fed convenes and the much-anticipated Trump-Xi get-together in Asia.
And this is important because it really goes together. As these two leaders of the world's biggest economies get together, the question is who has the leverage? Who has the bigger impetus to really cave in some sort of new normal as they try to get some stasis? And ultimately, that will come down to the economy. Who is weathering the storm and some of the changes better? And that right now is what a lot of people are parsing through with all of the data. And that's the reason why this sort of clarity in the fog of the CPI is going to be important.
Before we get to Thursday and these two leaders sitting down, what's going to be really important for the market is what happens this weekend. What kind of tone is set when Heli Fang sits down with the Treasury Secretary Scott Bessent? And what kind of parameters of a potential deal could we see following that meeting? Because they're going to set this table for Xi Jinping and Donald Trump. Base case is we just get an extension of this truce that is going to be ending on November 10th.
Such a massive week next week. A get-together between China and the United States, a Federal Reserve rate decision, and seemingly the data this morning has absolutely no relevance to any of those things based on what we've heard. Headline CPI could have a 3 handle later on this morning, and this Federal Reserve still going to cut interest rates next Wednesday.
I would take that a step further. It likely will have a 3 handle when it comes out later this morning, and people are going to look past it because there aren't necessarily the inflationary inputs on a longer lasting basis. And also, nothing has materially changed since the last time that Fed Chair Jay Powell said that he is going to cut rates essentially for all intents and purposes. Question is, what is the signal coming from earnings also? Yes, we're getting CPI, but next week we are getting more than 40% of the S&P 500 reporting earnings. And so far the earnings have been blockbuster good relative to expectations. So how do you pair the idea of an economy that's weakening, an employment market that's flagging, with the idea that earnings are coming in better than good, and you have a CPI coming in hotter than you'd like? How do you pair those things together and get a Fed that's cutting?
I think we get $10 trillion plus a market cap reporting just on next Wednesday alone. So big couple of days coming up next week for earnings season. Big tech in focus. Equity futures this morning positive by 0.3%, on course for a second week of gains on the S&P 500. Coming up this hour, we'll catch up with John Stolfus of Oppenheimer, with stocks holding near all-time highs. George Pollack of Signum, with President Trump and China's President Xi set to meet. And the former Kansas City Fed President Thomas Hoenig ahead of CPI data later this morning. We begin this hour with stocks rising as markets await the latest read on inflation. John Stolfus of Oppenheimer writing, our intermediate and longer-term outlook for the U.S. economy and the stock market remains decidedly, drumroll, bullish. John, the most bullish man on the street. Good to see you, sir. Good morning.
Good to see you, too. Thanks.
Let's get to some of these questions regarding inflation. How relevant is this morning's CPI data to today's market?
I think as long as it comes in line or close to in line, I think we'll be fine. If it's a drastic surprise, then, of course, to higher inflation, not so. And if it's also a much lower inflation, then people say we're in trouble. Is the Fed going to do 50 instead of 25? So it's any kind of action that can create bips for the traders you have to watch for. But we think it'll be it'll come in line with expectations, and we think that we'll get a cut tomorrow.
It's important to the extent that it shapes perceptions of Federal Reserve policy for next week and beyond. Does it shape perceptions of monetary policy for next week and beyond?
You know, I think we've said for a long time, we think the Fed is making down payments to Main Street and to Wall Street to give them an idea. Indeed, this monetary tightening policy period is ending. It's just not ending as quick or as deep in terms of the cuts as both Main Street and Wall Street would like. But sometimes, you can't always get what you want, but you may find you get what you need,
Well, at this point, we're looking at earnings that are coming in better than expected. We're looking at a Fed that's going to look past any kind of CPI print and cut rates. And yet, yes, you're bullish. At the same time, you're talking about going up in quality. Mm-hmm. How do you pair those two ideas?
Well, I think you have to be realistic in that the market has genuinely shown that it's still a little bit nervous about small and mid caps. You have these days when we go risk off, where they don't go completely risk off in a traditional sense. They're not running out of the market. But all of a sudden, you'll see the smalls and the mids will get a good day, versus the large caps. But when it comes down to it, people are concerned that perhaps the economy is weaker than perceived. We're in this blackout period without any data flow. So the thought really is it's you hug the large caps, but also the large cap stocks appear to be the most resilient when it comes to earnings. If you look at the earnings reports for the last earnings season, fourth quarter, first quarter, second quarter, and thus far third quarter, this looks good.
I love a good cliche on a Friday morning. What inning are we in here? Just because that is sort of a question, given that some people were talking about almost recession-like conditions earlier this year that have really revived, and a sort of reacceleration now into the beginning of next year.
Yeah, I'd say, we've thought for a long time, because of the change in the Federal Reserve's policy and the way it acts, how quick it acts, and how communicative it is, that essentially we've for a long period it's an extended mid-cycle. I like to say the economic cycle is as wide as the Amazon, and we mean the river, okay? Because it's been going on for a long time. How often have you heard from the bears we're late cycle, and that all of a sudden some of the most bearish in the past are saying we're actually coming to early cycle, and we're going back and forth. No, I think it's a big fat mid-cycle, and it's because between the Federal Reserve policy, this Ben Bernanke legacy, as well as increased use of technology, creating greater efficiencies for both the consumer and business, and experience that's been garnered from all these things, whether it was the financial crisis, COVID, coming out of COVID, supply chain, trade wars, all this stuff. It's better than expected, and it's resilience. It's not, what was the old word they used to always, robust. Heck with robust. I will take resilience is what I like.
Well, you have a very long-term view.
Yep.
Short-term, though, there's a lot of policy uncertainty. What gives you the most angst?
Annmarie, what gives me the most angst is it has very little to do a lot of times with the market. It's just that the popularism of socialism and communism, which are failed ideologies, is rising in different places around the world. But I think related to what keeps me up at night is just I look at valuations, and as long as it's recognized that valuations are probably higher than historical standards would have us at this point, what we're believing is that people are investing more seriously than ever before, at least in the U.S., because they recognize Social Security will simply not be the same percentage of income in retirement. And people are worried that they might live too long. They don't want to lose their living standards. And so people go to equities, which historically have proven to be past performance, no guarantee of future results. But it's that equities have shown resilience in dealing with inflation, changes in the economy, changes in trend. It's good to own a good business.
This must be a generational thing. Who do you know that worries about living too long?
Well, but everybody.
I was going to say the same thing.
Do you know anyone?
Not at all.
If you look at it, though,
another year.
What they report in terms of investor behavior, it's cross-generational. So you still have, among the youth, you still have the desire to gamble in a bull market. It's the crypto, it's gold or silver.
I admire their bias to take risks, don't you?
Oh, absolutely. And you need that. It's good for liquidity. But they also are investing seriously on the other side of it because they recognize that this Social Security, it's not that the politicians are going to eliminate it. That would be like an insurance company default. Sure. And those people would never get elected ever again to anything. But they recognize it just will not be the same support that it was, the same safety net.
I think America gets it. I think it's the Europeans that don't. The state is just not going to be there for them. Particularly our generation. In the coming decades, the state is not going to be there for them in the same way. Do you see the Europeans doing the same thing, a bias to invest, to participate in capitalism in this equity market?
I think from a cultural perspective, it's more difficult to move towards that. You've begun to see it just in terms of, if you look at elections in Europe, if you look at the way the market is beginning to respond to needs for development of technology to some extent. All of that shows that things are changing, but slower because it has been, Europe and the UK have been steeped in socialistic practices that are big government. and that's expensive bureaucracy for the services provided. And there's a move that's beginning to happen. It's a pendulum that's slow, and politically it's, gosh, you have to avoid missing the signal for all the noise on a day-to-day basis. But the market is telling us this is actually manageable. And if anything, the alternative to cooler heads prevailing is much too awful to move towards.
Well, and this is really the key question. Are things better than expectations? What we saw this morning out of Europe were PMIs that actually came in better than expected, led by Germany. France is its own story. I'm just wondering, how much you can get excited there, or how much you really are staying focused on the United States based on the underperformance of the dollar so far this year, and based on the fact that you do have the base of people who very much are going to invest in preparation for reduced benefits down the line.
I would have to say we're still overweight U.S., but we say meaningful exposure to both developed international markets as well as emerging markets, because there you've got combination of valuation, demographics, where they are on the timeline of their financial history, at an attractive area. But we would have to say in the U.S. it's accountability, transparency, and governance. For all the arguments that we have, we do have all kinds. You just see it in all the court action that happens in Washington. It's you've got people can still work things. There's a potential to work things out. The other thing is the dollar. When I look at it versus the Bloomberg dollar index, which is my favorite because it includes the emerging markets as well as the IFAs. What you've got is it was up last year. It was up about 7.98%, not to get too specific. And this year, it's down something like somewhere between 8 and 10, depending what day you look at it. It's down. Essentially, it's just giving back after a period of the dollar being so incredibly strong, because in an uncertain world, when things get really bad, all the world moves towards Papa, which looks like Uncle Sam.
And so much of that dollar weakness so far this year, first quarter story. So much of it in the first few months of this year. John, it's good to see you.
Great seeing you.
Thanks for dropping by. Thank you, sir. John Stolfus there of Oppenheimer. Equity futures on the S&P just about positive here by 1/3%. We are poised for another week of gains with an update on stories worldwide with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. President Donald Trump has terminated trade talks with Canada, citing a TV advertisement from Ontario. The commercial features excerpts of then President Ronald Reagan defending free trade. The president's accusing Canada of timing the ad to interfere with the Supreme Court case against his country-by-country tariffs. Arguments in that case are set for November 5th. Meanwhile, talks between U.S. Treasury Secretary Scott Bessent and Chinese Vice Premier Hu Lifeng are scheduled to take place in Malaysia this weekend. The meeting comes ahead of President Donald Trump's sit-down with China's Xi Jinping next week. President Trump wants China to resume American soybean purchases, crack down on fentanyl, and back off restrictions on rare earth exports. And a federal sports gambling probe is rocking the NBA. Miami Heat guard Terry Rozier and Portland Trailblazers coach Chauncey Billups were arrested and charged yesterday, along with at least 30 others. The arrests are linked to 2 separate illegal gambling schemes, one of which is connected to the mafia families in New York. The NBA has placed both Rozier and Billups on immediate leave. That's your Bloomberg brief. John?
Yahara, thank you. The most bizarre story of the week so far, isn't it? Just crazy.
Can't wait for the
Wild.
movie. Unbelievable. And they use like James Bond technology at poker games. It's insane.
Yeah. Okay.
Why do they need more money?
I got nothing good to say about the NBA right now. Up next on the program,
I was about to say.
Talks with China.
On November 1st, the tariff on China goes to 157%, which is record-setting territory. And we don't want that because it's not sustainable for them. So a meeting with President Xi.
Up next, we'll catch up with George Pollock of Signum. He joins us in just a moment, live from New York City this morning. Good morning. Live from New York City, welcome to the program. Equity futures on the S&P 500 firmer here by 0.3%. On the Nasdaq, up by 0.5%. On the Russell, up by 0.4%. Under surveillance this morning, talks with China.
On November 1st, the tariff on China goes to 157%, which is record-setting territory. And we don't want that because it's not sustainable for them. They can't sustain that. We don't want them to have to go through that. So I'm meeting with President Xi, and I would say we have some big issues, like with the farmers and various other things. But the first question I'm going to be asking him about is fentanyl.
So here's the latest this morning. President Donald Trump and Chinese President Xi Jinping are set to meet on Thursday in South Korea as the world's two largest economies look to ease trade sanctions. Jack Fitzpatrick of Bloomberg Government joins us now from Washington, D.C. Just how high is the bar for next week, Jack?
The president has set the bar very high. He said previously that he wants a deal on everything. If you're talking about every big part of this deal, you heard him talk about China cracking down on fentanyl. We know there's a major focus on Chinese purchases of U.S. soybeans. There's a major focus on those Chinese rules around rare earth materials. I know a lot of people watching this very closely are skeptical that there's actually going to be a massive deal on every major component of this, and a winding down of tensions itself would be a big deal. But when you have these two principals meeting, President Trump has established he has very high expectations on some of the highest profile parts of this. So at the very least, the person going into this from the U.S. is going into it with a lot of ambition.
Jack Fitzpatrick down in Washington. Jack, thank you. To extend the conversation, George Pollack of Signum joins us now for more. George, let's go through the issues. Rare earths, soybeans, and then we've got the issues around fentanyl. Of those three, what's the hierarchy? What's the more difficult one to achieve?
I think for the president, the most difficult one to achieve is rare earths, because China understands that with rare earths, they have the U.S. in a disadvantageous position. And they remember when these tariffs were first implemented earlier this year, the car manufacturers came to the president and said, if you don't get the rare earths started, we're going to have to shut down production. And China knows that. And that's where the president's probably going to have to be most aggressive, but at the same time, understand China has the advantage.
Is China sending any signals that they're prepared to walk back what they have been doing when it comes to rare earths?
I think China's understanding of the rare earths issue is we haven't really done anything. And what we have done was more a response to your restrictions. And all we're doing is setting up a new licensing regimen. Rare earths are going to continue to come out, and you don't have to worry. So for China, we're happy with the status quo, but you decided to change things up, and you've decided to overreact and become more pugnacious.
Well, it's not just a new regime when it comes to rare earths. Any material that China exports that has an ounce of a trace of a rare earth needs to get a specific export license, which is why the Europeans are even considering using their anti-coercion tool. George, the fact that the Europeans are willing to go to the third rail, a tool they've never used in any negotiation, is that at the moment helping the United States into Thursday's meeting?
I think for the president, from Scott Bessent's viewpoint, it is helping the president give him a more global power and a more global idea that this can't go on. But at the same time, China is responding to this as, that's great that you're united, but we still have the advantage, and we don't understand why you're being so aggressive with us back and why you're deciding to play it so fast and loose.
So what's your base case then for Thursday? Is it just a continuing rolling truce?
Our base case is a continuing rolling truce where the U.S. and China understand the current situation where the president's threatening increased tariffs and the continuing threat of this new licensing regime kind of rolls back to an extent where we get back to the Geneva or London understanding. But that doesn't mean it's a positive situation, because we're still going to be having these situations pop up every couple of weeks where either the president is frustrated or China is frustrated.
In the past few weeks, it seems like the U.S. has been trying to mend relations with a number of traditional allies and create closer ties, which is a reason why, in the wake of the announced meeting between Xi Jinping and President Trump, the new tensions with Canada are interesting. How do you sort of understand that in the bigger sphere of negotiations with China?
In terms of the tensions with Canada, the way we view this is Canada's right now between a rock and a hard place with the canola tariffs and EV tariffs they've placed on China, and they need to get that restarted. But at the same time, they need to deal with USMCA renegotiation. And we've always thought that USMCA is going to be an aggressive renegotiation from the president, and things like transshipment and rules of origin are going to come into play. And I think for the president, he's making clear to Canada, you're either with us, the United States, or you're with China. You can't get both.
This feels like a long game of leverage, and that's sort of been the big question between the U.S. and China, who has the leverage, and people argue on both sides. China having the leverage in rare earth minerals, maybe the U.S. having a bit of an edge when it comes to technology and just the dynamism in the U.S. economy. I just wonder how much you expect there to be some discussion of Russia and oil purchases, how much that's on the table versus just getting there and figuring out how to jawbone and kind of poke your elbows out to sort of have the same thing that we have right now.
Look, I have no doubt that there's people in the White House who would like to discuss Russia, who would like to discuss oil, but I think the president's made clear his priorities are, among other things, fentanyl and soybeans, and I think that's where his focus is going to be. He is thinking short term right now, and most likely his biggest short term weakness is the farmers and is their inability to get assistance during the shutdown and inability to get assistance because China, for the first time in 7 years in September, did not purchase a single soybean.
Can you tell me, George, your date on the calendar, what's circled, when you think the shutdown finishes?
I think we're still taking the place that this ends November 1st. For us, Senate Democrats understand that at November 1st, the healthcare enrollment opens up. Republican voters are going to see that their premiums increase. And for Democrats, that will be, while it'll be negative for voters, Democrats will be able to say, we wanted to fix this. Republicans were the one who said no.
So you're basically saying it ends November 1st because Democrats will line up for the continuing resolution, not because they struck a deal with Republicans on health care.
I think what will have to happen is Senator Schumer will have to walk a hard line to not go down, but to navigate his caucus and to allow either the retiring members or the more moderate members to vote for it. And then message saying, Democrats wanted to fix your health care. Democrats wanted you to avoid these premiums, but Republicans were the one who were saying no. And that will be the Democratic win will be, one, making healthcare an issue in the election. Two, Democrats being able to take the 80-20 side of an issue, the 80 side of an 80-20 issue, and Democrats being able to say Republicans are the ones to blame for what is happening with your premiums. And if you want to punish them, the best way to do that is to vote for us.
George Pollack of Signum. George, thank you. Got to fix that clock. 20 minutes behind. All right? Make it happen. I noticed that. It's a distraction, George. Otherwise, fantastic conversation. A week tomorrow, November, by the way, it's just around the corner.
So November 1st, I think, is actually really soon to end this shutdown. I don't see any side blinking. Maybe this healthcare issue on November 1st, the enrollment opens up, could become a pressure point. But the fact that this administration is looking at ways to pay air traffic controllers, especially as we go into Thanksgiving, they're looking at ways to continue to pay the military. As long as those individuals, potentially, there's an off-ramp for them to get paid, I don't see why anyone is in a rush to open up the government.
So just to be clear here, it's not that it's different this time. They've just been able to push off those traditional pressure points.
Right, definitely when it comes to the military, and they're finding potential ways to get FAA workers paid. Can you imagine all your flights are delayed around Thanksgiving? That is not good optics for anyone in Washington.
You're going to have to wait even longer for the data.
Well, yeah, that's another issue. And even if the government reopens in the next couple of weeks, you're going to have to wait a while given the collection and just how messy it could get. But to the idea of travel, I just think it's really interesting that House Speaker Mike Johnson has come out and said we're close to running out of funds to be able to really cover the air traffic controllers. So it's going to get messier sooner rather than later. Again, who has the leverage? It's going to come down to the polls. And right now, the Democrats are doing better than the Republicans in the polls when it comes to the shutdown.
The complaints will begin to pile up over the next few weeks, I'm sure. Equities right now in the S&P 500, very close to record highs, up by 0.3% so far this morning. Up next, we'll catch up with Garrett Nelson of CFRA, with Ford posting some very strong sales but cutting its outlook. Plus, Danny's back with your morning movers. Intel up on an earnings beat. In a pre-market, that stock higher by more than 8%. What a few months that company has had. From New York City this morning, good morning to you all. You're watching Bloomberg TV. Heading towards a second week of gains on the S&P 500. Equity futures up by 0.3 on the week so far, up by more than 1 percentage point on the Nasdaq, higher by 0.5. Let's get you some stock movers this morning. Your morning movers with Danny Berger. Hey, Danny.
Hey, John. What a year it has been for Intel in this earnings season, really just underscoring that, saying that they're going to be profitable for the first time in some time, boosting their outlook. Intel shares up 8.3%. They have a lot going for them. They have the backing of the White House, from NVIDIA, from SoftBank. Also noting a PC rebound, that really supporting their earnings. I should just note Intel is up already 90% this year. At this pace, it will have doubled its share price from the start of the year. We also saw some earnings from Ford after the bell yesterday, to a $2 billion hit from a fire of a key supplier at an aluminum plant. But Ford outlined their vision for the future in which they can overcome that. Investors seem satisfied by that. They also pointed to sales of their heavy trucks and SUVs, echoing what we saw from GM, people willing to buy that. So shares up 3%. But apparently, what people are not willing to buy are Hoka's and Uggs. Decker, the maker of both of those brands, giving a really weak forecast. In fact, cutting their outlook for the second half. The CFO saying it is a consumer that is a little bit cautious. They cited tariffs specifically, saying that the higher price means that people have been pulling back. They are working on mitigating their tariff costs, about $150 million, saying that half of that they think they can mitigate. Either way, shares are getting crushed, down more than 11%, John.
Before that moved, the third biggest decliner on the S&P 500 so far this year. Include that move, and it's the worst performing stock on the S&P. Deckers have been absolutely hammered. I was going to say something worse. On our radar this morning, President Donald Trump terminating all trade negotiations with Canada following a Canadian advertisement against his tariffs plan, featuring the voice of the former U.S. President Ronald Reagan.
Throughout the world, there's a growing realization that the way to prosperity for all nations is rejecting protectionist legislation and promoting fair and free competition. America's jobs and growth are at stake.
The Ronald Reagan Presidential Foundation and Institute saying Ontario did not seek permission to use the remarks. Elsewhere, Argentine President Javier Milei is meeting with JP Morgan CEO Jamie Dimon in Buenos Aires before midterm elections this weekend. Sources telling us here at Bloomberg that Milei is also delivering a speech to Latin American CEOs at an event organised by JP Morgan. And finally, JP Morgan among banks preparing to launch a record $38 billion debt offering to help fund Oracle data centres in both Texas and Wisconsin. The possible deal is part of Oracle's effort to invest $500 billion in AI alongside OpenAI.
This is a fascinating story that keeps percolating out in terms of how Oracle is going to finance some of their promises, especially given that it's coming increasingly in the debt market. Now we're looking at tech-related debt in the overall corporate bond market that is exceeding the financial debt outstanding, which had been the previously biggest component. It just raises a question. How levered is this entire financial cycle to artificial intelligence and a model of it that is current but might not be future? And that, I think, is a fear that keeps coming back to a lot of investors.
And when it comes to these data centers, they're front and center for the Energy Secretary Wright. This morning, he is pushing out regulators and urging them to accelerate the process of allowing the data center sectors to actually hook up and connect to power grids. So the U.S. administration is really trying to push these companies to quickly get shovels in the ground when it comes to data centers and have them up and working with the power grids. Of course, this is going to become incredibly political next year, like we're seeing electricity prices become a hot button issue in both the Virginia and the Jersey governor races.
Issues like that have the potential to kick around the debt market. You're familiar with credit issuance. That's a big deal for the credit market.
It's unprecedented. We've never seen a deal that's that big. And it's tied to a company that has increasingly speculative deals. I understand it's not increasingly speculative as its own credit rating. Nonetheless, it has increasingly invested in companies that are below investment grade, that have also issued debt. And we are talking about suddenly new leverage coming into the story. That, I think, is a real question. How much bigger will some of those issues be in the debt markets, in the leveraged loan markets, in the private credit markets, given how much exposure there really is to this story?
That issue size is typically something you'd see coming from the Treasury. It's a big number. Let's turn to autos. Ford shares rising after topping estimates on third quarter profit and sales, but lowering its outlook after a factory fire and pausing production on the electric F-150. Bloomberg's Craig Trudell joins us now for more. Craig, welcome back to the program. We can put some pieces together now. What we heard from GM on EVs and what we just heard from Ford. What's the biggest story here?
Yeah, I think the sort of here and now story absolutely is that fire at Novelis, an aluminum supplier. It's been a while now actually that Ford's been sort of kind of the exception in the U.S. market with aluminum bodied pickups. So the fact that this fire took place, it meant that it was really going to hit them hardest because these are really their moneymakers, F-Series, full-size SUVs as well. So, there is going to be this, short-term bit of pain for the company. And we saw the shares really sort of take quite a hit a couple weeks back when, reporting on the extent of the disruption, involved here sort of emerged. But it does seem that investors are sort of, getting comfortable with the path out of this situation. And the ability of that supplier, Novelis, to get back on its feet before year end.
Craig, as we put the pieces together, what's underlying demand like right now from the consumer for these vehicles produced by these companies?
What's incredible is just the amount of demand for big SUVs, the likes of, the Lincoln Navigators or Ford Expeditions, at GM, the Tahoes and Escalades. Also full-size pickups, and I think the Trump administration has really sort of taken any handcuffs that were on the Detroit manufacturers with respect to emissions or fuel economy. We're now sort of letting loose in those regards, and these companies, honestly didn't wait for those policy changes. I think the writing was sort of on the wall based on the way that Trump was campaigning on those issues. And we've seen them, boost production and the consumer eager to buy those. I think, you look at Stellantis as a prime example there, where under the previous CEO, Carlos Tavares, he was trying to wean them off, very, very old V8 engines in their pickups. Once they brought that engine back, you've seen actually the consumer really, sort of eager to go back to Ram and get themselves a V8 Hemi, which I think we've spent the last few years with all of our attention on this transition to EVs. It's been very clear that the American consumer was not quite as ready to make that transition as I think a lot of people thought, a year, even 3 years ago.
Craig, I think that's such an important final point. Craig Trudeau there of Bloomberg. This is not just about EV tax credits and all that stuff. This just wasn't where the consumer was in this country.
They weren't where the consumer was, and a lot of that has to do with the infrastructure of how there's not a lot of charging stations that were set up. And the Biden administration tried to put more charging stations out there, but it just didn't come in time as they were pushing for electric vehicles. The EV subsidy is basically the same price as just buying an entry-level BYD car, which I find fascinating.
Isn't that amazing?
It's $7,500 basically. Either get the subsidy or just buy a car from China.
Ford in the pre-market high, by the way, up by a few percentage points. Garrett Nelson of CFRA writing, the beat combined with an expectation that the company can recover $1 billion of the fire impact takes the worst-case scenario off the table. Garrett joins us now for more. Garrett, welcome to the programme. What a year it's been for these manufacturers, stuck between really volatile tariff policy and changing policies around emissions as well. Out of all the companies that you cover at the moment, Garrett, who's in the right place at the right time?
Yeah, thanks for having me. Actually, the only stock in the auto manufacturing industry that we have a buy on right now is GM. And I think when they reported earlier this week, it really demonstrates why we are bullish on the company. Very solid quarter, significant increase in their full year guidance as fears around tariffs have really gone away. GM was hit arguably the hardest of any auto manufacturer back in the spring when the tariffs first were announced, and so we like GM the best. They're returning a lot of cash to shareholders in the form of buybacks, and we're largely neutral to negative on the rest of the industry. We have a hold on Ford, and we have sells on strong sell on all the EV manufacturers, Tesla, Rivian, and then we have a strong sell on both Lucid and Polestar.
How much, Garrett, does this have to do with where consumer demand is right now? The fact that people are going into more expensive trucks, which has really supported what General Motors has been doing, and not into, as you say, electric vehicles and some of the products that Ford more heavily manufactures.
What we're seeing across the industry is that the auto manufacturers who made bigger bets on hybrid vehicles several years ago, which is largely the Asian manufacturers, such as Toyota. Toyota sells more hybrid vehicles in the U.S. than all other auto manufacturers combined, as well as Honda, a big hybrid seller. They are really now benefiting from consumers who are have shown that they're comfortable with hybrid vehicles, but just not as comfortable with electric vehicles. In fact, hybrid vehicle growth last year was in the U.S. Sales growth was about 5 times the growth rate of electric vehicles. And so, Ford is another company that's had success with their F-150 hybrid and their Maverick hybrid. And you're going to see a lot more hybrid models coming to market here over the next few years. And we think there's really tremendous pent-up demand for hybrid versions of the large SUVs because Americans love their SUVs.
We've been talking about cars for the past 10 minutes, and we haven't talked about tariffs, which is notable to me, given the fact that they were supposed to be at the epicenter of the pain. And in many ways, the idea of auto-related jobs has been at the epicenter of a lot of trade disputes. I just wonder, do you think that that story is over? Do you think that GM and Ford and Tesla, although Tesla was in a bit of a different position, have brought jobs back to the United States, rejiggered their supply chains, and are now more immunized?
Well, these moves, we've seen a number of announcements. Stellantis most recently made a big announcement a week or two ago that they're investing. I think $13 billion was the number in the U.S. So you're starting to see some of these announcements. The problem is it's a multi-year thing. It's going to be years before these factories are actually built and up and running. But I think the tariff issue is largely in the rearview mirror, and it has been really for at least 3 or 4 months now. But of course, there could always be new tariffs announced. This is the environment we're in with this administration. And I think there's a fair amount of nervousness regarding what could be announced going forward. But I think the attitude of the street and investors right now is, not so much on tariffs and more looking out to what demand looks like in 2026 and 2027. There's 2 very powerful tailwinds here for the industry, and that is interest rates are now declining again, and oil prices, crude oil prices, back hovering right around $60 a barrel, well below where they were at the start of the year. So those are 2 very powerful things for the industry that they have going for them.
Garrett, at the same time, we know the supply chain when it comes to the autos is deeply connected between Canada, Mexico, and the United States. And I woke up to a Truth Social from the president saying all trade negotiations with Canada are terminated. If you're an auto sector CEO, what are you doing about this?
You're diversifying your supply chains, and I think it's what they've been doing for the last 6 months or so. Even before that, really going back to the election, when Trump won, for almost a year now, given what that he really campaigned on the tariffs and making the tariffs a cornerstone of his economic policy. So I think the auto manufacturers have taken steps to mitigate the effect of the tariffs, and they're diversifying their supply chains going forward.
Garrett, can we just finish on a different story? Subprime auto lending. There's clearly been some problems building for a long, long time, and these companies apparently so far untouched by it all. But how does that inform the new car market, what's been happening and developing in this country for a number of years?
Yeah, I think you're seeing especially dealerships and manufacturers really, becoming more cautious with consumers. You mentioned that there was the Tricolor bankruptcy just a few weeks back. And I think that really raised escalated concerns regarding the consumer. We're seeing a lot more distress at the lower end of the income spectrum among consumers. And really that bifurcation between the high-income consumer and low-income consumer has been widening for some time now. But you're at a point where there's actually a lot of distress among lower income consumers. So I think you're going to see the industry being a lot more cautious in terms of their loans going forward. And I think certain auto retailers have been hit if you look at the equities, just given concerns about what might be in their loan portfolio.
One to watch over the next few months, maybe. Garrett, thank you, sir. Garrett Nelson there, a CFRA on Ford, GM and Tesla, covering a range of companies here in the United States. The favourite GM. Right now, the equity market very close to all-time highs. Positive story, up by 0.3%. With an update on stories worldwide with your Bloomberg Brief, here's Yahira. Hey, Yahira.
Hi, John. The U.S. government shutdown is now in its 24th day. Yesterday, Senate Democrats blocked a Republican bill that would have paid members of the military and federal workers who've had to stay on the job. Democrats say the bill would give President Trump too much leeway to decide which government employees have to keep working while the standoff continues. Meanwhile, Binance co-founder Changpeng Zhao, known as CZ, has received a pardon from President Trump. Trump told reporters that it was done at the request of, quote, a lot of good people, though he has never personally met him. The move marks the latest act of clemency the White House has granted to a crypto entrepreneur, underscoring how the Trump administration has positioned itself as a friend of the industry. And Target has made the decision to eliminate about 8% of corporate roles in its first major restructuring in years. According to a memo seen by Bloomberg, the retailer is cutting 1,800 roles across various teams, including 1,000 layoffs and closing out 800 open roles. No roles in stores or the supply chain have been impacted. That's your Bloomberg Brief. John.
Yahira, thank you. Thank you very much. Up next on the program, sticky inflation.
We're not getting much progress on inflation. That this report actually is going to be a continuation of numbers that are at 3% or higher rather than moving down towards 2%.
Is that a problem for this Federal Reserve? Up next, the former Kansas City Fed President Thomas Hoenig from New York City. You're watching Bloomberg TV. We've had a bit of disruption over the last 2 weeks. Think about three things: volatility around the US-China story, flashy headlines about credit, tighter restrictions on Russian crude, and yet equities, the grind higher continues. On course for 2 consecutive weeks of gains and up another third of 1% on the S&P 500, on the Nasdaq up by 0.5. Under surveillance this morning, sticky inflation.
We're not getting much progress on inflation. That this report actually is going to be a continuation of numbers that are at 3% or higher rather than moving down towards 2%. So that is a challenge for the Fed as it tries to weigh how much emphasis to put on inflation and how much emphasis to put on what's happening in the labor market.
So here's the latest this morning. Traders awaiting the September CPI print due out at 8:30 Eastern Time. The estimate in our survey is expecting core CPI to stay above 3%. The former Kansas City Fed President Thomas Hoenig writing, if the CPI stays at or moves above 3%, the Fed will be hard-pressed to justify additional cuts unless the unemployment rate spikes surprisingly to the upside. Thomas joins us now for more. Thomas, welcome to the program, sir. Let's build on some of that commentary. We should get a headline read of 3%, maybe 3% plus, based on the estimates we've got on Wall Street so far this morning. Thomas, why doesn't that compromise the decision to cut interest rates next week?
Well, remember, number one, 3% is not even close to price stability. And it's well above, 50% above the Fed's 2% target. So they have a credibility issue there. Now, one of the things the Fed has done is made it very clear that it's kind of rotated towards focusing on the employment numbers. That seems to be carrying the day, and that's why everyone expects another quarter point cut. But I would say that if it stays at 3%, they will do the 0.25% cut. That means real interest rates will be 1% or less. That's very stimulative, I think. And that will push the economy forward. So they have to be pretty careful about how much they signal more cuts going forward. And whether they should be cutting, I might question, but that seems to be pretty much on their agenda given their rotation towards employment concerns.
Thomas, based on commentary we've had so far, particularly from the Fed chair, tariffs and trade is not a source of inflation they're particularly worried about. Is there a source of inflation, from your standpoint, in your mind, that threatens the Fed's easing bias?
Well, I think inflation, the sources of inflation, I think tariffs will still carry some more upward pressure, perhaps not as much as people had originally thought, but I think it's still going to be a factor. I think you also have playing with this in this environment. You have this wealth effect. I think Meredith Whitney, who writes on consumers, said there's so much real wealth tied up in the housing market. Home equity lending is going forward. We're seeing some re-leveraging there. Those are factors that will increase demand and put more pressure on inflation. The Fed has to be aware of that. And I think that has to be in their calculation. But I think they're under pressure to cut, and I think they will tend to do that unless we have an upward surprise in that inflation number well above the 3% number, 3.2, 3.3, something like that. Then they're really going to have to rethink things, I believe.
Thomas, can't you argue that this is a Fed that has been inclined to run this economy hot and keep rates artificially low for a pretty long time?
I think it's their yes, I do. I think they've been very sensitive to keeping the economy strong, demand strong at least, and that has carried the day. And that's particularly they're getting pressure from the administration to do that right now. So their inclination will be to lower the rate so long as inflation is 3%. That's kind of the new normal for them, it appears, which I think is unfortunate.
Isn't there a sort of additional mandate that's coming into play that nobody wants to talk about, which is fiscal sustainability? And I understand that this is coming in part from the administration, but this has really predated the administration. And increasingly, a lot of people have seen this as a potential input for the Federal Reserve. Deutsche Bank put out a report saying that from 1942 until 1951, one of the main ways the U.S. reduced the debt was keeping rates artificially low. I mean, how much do you see that as something that's sort of a de facto part of Fed calculus going forward?
Well, I don't know that it is, but it should be. I think the fiscal challenge, the Fed will become increasingly under pressure, given that the reserves have come down, the so-called excess liquidity in the market seems to be coming down, and the fact that we have $2 trillion of debt to fund, new debt to fund. The Fed is now going to become a fiscal enabler as we go forward from here, and that will be the pressure they put on it. And that's only going to make their challenge about maintaining price stability all that much more difficult. So they better be thinking ahead towards that, and they ought to be having some conversations, I hope, with the Treasury about this. And that's really part of the standoff. The fiscal challenges, our main issues going forward as far as inflation goes, is the pressure on the Fed and the ability of Congress to find some kind of compromise around the fiscal challenges that are building. I mean, they're there, and yet they're getting worse.
Best of luck with that, Thomas. Thank you, sir.
Yeah.
Thomas Einig there, the former Kansas City Fed president, an issue I think we'd all love to see dealt with. It's curious that we've seen these complaints leveled at this Federal Reserve, because if this Federal Reserve has been reckless, it's been recklessly dovish, not recklessly hawkish, and they're the complaints we often hear on this program.
And frankly, they've been recklessly dovish for a long time. And part of it is because of fiscal sustainability. And when you look at the debt expansion over the past 5 years, it has been facilitated by a Fed policy that has really bolstered that and bolstered the ability to take on debt. Going forward, how able are they to truly be independent in the traditional sense when there are these fiscal sustainability concerns that are real? And that is something that increasingly people are asking and factoring into their calculation for the Fed.
I acknowledge the importance of the politics of the debt story, but I think as the politics of the labour market story, particularly under this Fed, where this Federal Reserve has really been spooked by any kind of weakness that developed in the labour market. You know, we used to say that cycles don't die of old age, the Federal Reserve kills them. Not this Federal Reserve. This is a very different Fed.
They were scarred by 2008 and the scarring in the labour market, and they're trying to get ahead of it, and that clearly is the priority.
Up next on this programme, we'll catch up with Kristen Bidley of Citi, Scott Lincecum of the Cato Institute, Ozan Tarman of Deutsche Bank, and Ashok Bhatia of Neuberger Berman. The second hour of Bloomberg Surveillance, up next.
We are deprived of macroeconomic data at the moment, so we have to rely on earnings results.
The engine of earnings growth is going to be in those tech names.
There is a genuine risk that actually the earnings beat rate will be even better than in the second quarter.
We have to rely on these earnings, and they're continuing to say that the U.S. consumer is very resilient.
The day-to-day noise around uncertainty is high, but I think all of that starts to come down, and America does really well in the next couple of years.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 positive this morning, up by 0.3%. On the Nasdaq, up by 0.5%, heading towards a second week of gains. Some data. Yes, really. 8:30 Eastern time. We finally get some economic data. CPI, a delayed report for the month of September, just around the corner.
Yeah, how much does it matter is really going to be key. I'm curious how much the market could potentially react to CPI. Is it potentially a bigger surprise to the downside or to the upside in terms of the market response? If, let's say, CPI comes in below 3%, which it's not expected to, do you suddenly start to see 50 basis point rate cuts getting priced in through the remainder of this year? And alternatively, how high is the bar for inflation to come in for the Fed to truly consider not cutting interest rates?
Mike Gapin of Morgan Stanley wrote a nice note on this. I don't think anyone thinks this is really going to change the story for next Wednesday, interest rate reduction. What it could do is constrain their ability to guide beyond October, because we know there's some division on that committee. We've got to settle a range of issues, including US-China trade talks. We've got a date? I think we've got a date for next week.
Thursday, Xi Jinping is set to sit down with President Trump, according to Caroline Leavitt, the press secretary. More importantly, though, the Treasury Secretary is sitting down with his counterpart this weekend. So by Monday morning, the market actually might have some clarity on the parameters of what we can expect from this meeting. Libby Cantrell of PIMCO was talking about this earlier. She just is expecting basically a détente of the most fiery rhetoric we've heard over the past 2 weeks. And basically we go back to a rolling basis of what these two countries have agreed upon. This story is going to heat up once again next year.
And maybe that's good enough for now. Companies have re-engaged. We saw that with the bank earnings. Are consumers going to re-engage in a major way into year end, into the holiday shopping season?
That's ultimately the key question. And really, that is really something that even CEOs cannot respond to. Yes, you see travel coming back, but retail clients, you can see, have really hesitated to order their toys from Mattel or really come out and make suggestions about how much they can increase prices into year end. I thought that this was the line of the day from Ian Lincoln of BMO Capital Markets yesterday. In the land of the data blind, the one-off headline is king. This is the reason why a subprime mortgage default or a retailer that can't sell toys is going to really drive market activity heading into year end.
The president focused on the automakers this morning, just putting this out on social media. Ford and General Motors up big on tariffs placed on big and mid-sized trucks coming from other countries. Thank you, President Trump. Do you want to explain what's happening with the automakers?
Well, actually, what is happening is that Ford and GM are reporting less of a tariff hit than they originally were guiding for. Now, partially is that because the administration has made it a little bit easier, pushing out the timeline for a reduction of a tariff level for imported auto parts. So you heard from the CEO of Ford yesterday on Bloomberg TV saying to Matt Miller, thank you, President Trump, for that light reprieve. But at the same time, they're still taking hits when it comes to tariffs.
Lisa said it. In the conversation with the analyst in the previous hour on automakers, we've been talking more about emission standards than we have about tariffs. That's got to be key for some of these players. If you want to sell a standard Ford F-150 and you're making big fat margins on those cars, then you get to sell far more of them for a lot longer.
And the truth is, a lot of these companies have also been moving jobs back to the United States, and they've been able to do so. And that's behind what's going on with Ontario, because that is the main car manufacturing center of Canada, and they're upset that they're losing those jobs. So you start talking about President Trump talking to the automakers. He's also doing another kind of, little pinch to Ontario in the wake of what happened overnight.
Ford in the pre-market higher by more than 4%. Coming up this hour, Kristen Bidley of Citi with tech earnings driving equities higher. Scott Lincecum of the Cato Institute ahead of a high-stakes Trump-Xi meeting. And Ashok Bhatia of Neuberger Berman as the Fed eyes a long-delayed inflation print. We begin this hour with stocks rising on upbeat tech earnings. Kristen Bidley of Citi Wealth writing earnings are continuing to drive bullish equity sentiment in the absence of any macro catalysts. Kristen joins us now for more. Kristen, good morning.
Good morning.
You said earlier this year, fully invested, US bias. Is that still the same story?
Still the same story. We have a modest allocation to cash in portfolios, but I think the major question is really right now is, are we in a bubble? Like, is there something that's going to break kind of this AI euphoria? And I think you have to draw a comparison to prior bubbles and say right now, this is not fueled by leverage. It is not fueled by debt. It is fueled by a select few companies that have significant free cash flow generation and continuously put up record earnings. So as long as the earnings story is there from a fundamental perspective and it's not driven by debt financing, I think this is something that could continue.
Is the fate of this earnings season then on 2 days next week? Wednesday and Thursday?
I think they're very important days. I think when you look at the broader expectations, you have those top companies representing about 15% earnings growth. And if you were to take them out, it'd be closer to 6 to 7% overall. So you're seeing that contribution. But I think for the most part, even just the first couple of weeks, we've seen a lot of not only like beats, but beat and raise. The numbers of actually declining expectations, it's been sub 5%. So I know we're going into the biggest week of the earnings season, but I think generally people are pretty optimistic.
Earnings have been better than expected, and they've been increasing their expectations going forward. You've seen economic data. Oh, yeah, wait, we don't get economic data. But the commentary coming out of a lot of these earning calls have been really positive. I just wonder why you've seen this shift out of momentum trades, why you've seen a shift out of some of the riskier stocks and riskier investments in bulk over the past couple of weeks, if the evidence that we have points to a pretty positive outcome.
Well, I think this whole concept of a K-shaped economy also expands to the market. And so this concentration, like we have to address the fact that there is a concentration, not just in the market capitalization, but also in GDP, also in the consumer. So when you back into what's actually driving this, you have those free cash flow generating companies that are very well positioned, but being positioned in ones that are exposed to debt. You know, recently a lot of people have been talking about small caps. And I think the truth of it is when you're asked to actually name a couple of the top companies within small cap indices, very few people can do it. And so understanding where you have exposure in this market is really important, which is why the momentum has been kind of pulled out of some of those trades.
Are they worth going back into, or is that a healthy kind of blowout and you want to just avoid at all costs?
Our view is to stay with quality here. I really do think that, you know, given some of the risks that we still have, whether that's inflation, whether that's tariffs, there's still a lot of uncertainty in the market and how that will flow through. So staying with the free cash flow generators and quality bias makes a lot of sense.
A lot of uncertainty, but why is the market just almost completely ignoring it?
It is completely ignoring it because, well, right now, we don't have a lot of data, right? So I think we get our CPI print, which is very important, but its earnings season has become front and center, and earnings have been strong. So you've seen a resiliency in that data. You've also seen a resiliency in the economic data. Aside from some fractures within the employment backdrop, GDP is very strong. Now, if we break that apart, you could again point to the fact that, you know, this is the first time that we've seen another area of the economy overtake consumer spending. So now all of that AI CapEx is now overtaking what traditionally would be driven by consumer spending.
What happens if earnings season wraps up and the government's still shut down and all we're getting is CPI reports?
Then I think you have to go off the data that you have. And I know that's very tricky and it puts the Fed in a very tricky position. But I think, you know, next week is one thing where you can say, all right, there's not enough of a distance here. And we do think that they're going to cut 25 basis points. But I think going forward, it becomes, what can we rely on? Private market data, earnings, and really the earnings calls become so critically important in terms of getting clues from what is the actual consumer sentiment, how are they spending, are we still seeing this massive concentration of, you know, the top 10% of income earners driving 50% of consumer spending. So we're going to have to look to signals from management.
We're in about an hour and 20 minutes away from the CPI print. You mentioned inflation as a risk, and yet markets don't seem to be really waking up to that fear longer term. We did see, though, yesterday a rise in bond yields in tandem with oil prices going up. And I just wonder how much of a risk factor this is. The idea that oil prices do spike, whether it is geopolitical tensions and more sanctions or whether it's something else. And that does lead to a reassessment, a fundamental reassessment of inflation longer term.
So I think right now, like what's happened this week was obviously driven by sanctions, driven by specific events. Still on a relative basis, oil prices are relatively low compared to where we've seen them over time. I think the major thing is you have to kind of strike this balance between what are the inflationary forces and what are the disinflationary forces. Inflationary forces, we can point to tariffs, we can point to immigration policy, but the disinflationary forces of AI and productivity gains, there's a balance there that I think people are trying to see through.
Credo technology. I always check when people say that about the small caps. $26 billion, which would make it a top 50 stock on the FTSE 100.
I love Credo.
It's like small cap in America's big cap in the UK. Kristen, it's good to see you.
Good to see you too.
Thank you. Kristen Bidley of City Wealth. People were like, never heard of it.
What do they do?
Biggest stock on the Russell. All right, let's get you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Ukrainian President Volodymyr Zelensky says he won't recognize any territorial swaps during potential peace negotiations with Russia. That says he doubles down on Kyiv's fight for its sovereignty. Zelensky's comments come after his recent meeting with President Trump, who's been pushing both sides to agree to some kind of territory swap. Meanwhile, Argentine President Javier Milei's approval rating has fallen to a new low ahead of Sunday's midterm vote. According to the LatAm Pulse, Milei's approval rating dropped to 39.9%, while his disapproval rating jumped to 55.7%. Today, Milei will meet with JP Morgan CEO Jamie Dimon and deliver a speech to Latin American CEOs. And Ford shares are rising 4.3% in the pre-market after the automaker reported third quarter earnings that beat analyst estimates and signaled it will largely bounce back from a fire that disrupted a key supplier. The company also said it is pausing production on its electric F-150 Lightning to focus on more profitable models of hybrid and gas-powered vehicles. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next, a high-stakes meeting.
On November 1st, the tariff on China goes to 157%, which is record-setting territory. And we don't want that because it's not sustainable for them. So a meeting with President Xi.
That meeting scheduled for next Thursday. Up next, Scott Lincecum at the Cato Institute, live from New York City this morning. Good morning. Stocks are up by 0.3% so far this Friday morning, heading into the weekend in the green on the week and on the session on the Nasdaq 100 higher by 0.5. Under surveillance this morning, a high-stakes meeting.
On November 1st, the tariff on China goes to 157%, which is record-setting territory. And we don't want that because it's not sustainable for them. They can't sustain that. We don't want them to have to go through that. So a meeting with President Xi, and I would say we have some big issues, like with the farmers and various other things. But the first question I'm going to be asking him about is fentanyl.
So here's the latest this morning. The White House announcing President Trump and the Chinese leader will meet in South Korea on Thursday. The visit would mark their first face-to-face talk since President Trump's return to office. Joining us now is Jack Fitzpatrick of Bloomberg Government. Jack, fentanyl, why is that the major focus for this president?
Well, that's certainly the easiest to sell to the American voting public. He does acknowledge some issues with American farmers. Purchases of U.S. soybeans are another big one. But the focus on fentanyl in the political debate has been so severe and so long-running, and something that Trump has focused on as an aspect of a lot of foreign policy. It's not surprising to see him emphasize that in talks with China, as he has in his dealings with Mexico and South America and a variety of other countries. So publicly, you know what the president is going to pitch people on. It's what he can do to keep Americans safe, what he can do for farmers. He faces other questions. Obviously, the rare earth materials issue is something they've brought up quite a bit. The question of how he handles what China wants from the U.S. on the question of Taiwanese independence. They want an opposition to that. There's a lot on the president's plate, but you see a president who remembers what he can sell to the American people, and those two pieces, fentanyl and soybeans, and broadly what he can do for American farmers, are obviously going to get a big focus from President Trump.
Jack, fentanyl was a big part of the campaign. It's unbelievable to say that we're almost a year at the year mark from the election of last year, and the enforcement we're seeing of fentanyl in places like China, and the strikes we're seeing off the coast of Central America as well. Jack, what's the reaction in Washington, D.C. been like to all of this?
There has not been any hesitation from Republicans to support President Trump's foreign policy at this point. You're going to hear some grumbling from Democrats, but that's not really the focal point of where they're choosing to pick fights. So when you watch the shutdown, they're trying to focus on health care, a kitchen table issue for voters. Largely, you're seeing, as I said, a focus from both parties on what they can pitch Americans as kitchen table economic issues, and the foreign policy objectives of the Trump administration, even when some people get frustrated, are not the major fighting point. So he's being given quite a bit of latitude when it comes to issues like fentanyl, really effectively from both parties.
Jack, thank you, sir. Jack Fitzpatrick there, down in Washington, D.C. Scott Lincecum of the Cato Institute writing this on trade. The Trump-Xi meeting is back on, with lots to cover. Markets expect a taco walk back on both sides, so we'd see big moves if things fall through. Scott joins us now for more. Scott, good morning, sir, and welcome. I think we have to take stock of things. I said it's been a year since the election. It's been more than 6 months since April 2nd. And I was just speaking to an economist in a commercial break, and we were going through things we've got wrong on tariffs. Consensus has been wrong about tariffs in two ways, pass-through one and retaliation the other. Retaliation has been quite limited, Scott. How are you taking stock of things?
Well, the frame was looking at the last time around on retaliation and the traditional approach to retaliation. You know, during the first Trump term, you did see Europe retaliate, India retaliate, Canada and Mexico retaliate, and of course, China retaliate. This time around, it's narrower. China, of course, is retaliating, hence the big meeting next week to try to diffuse some of that. Canada's retaliated a little bit, but everybody else has really held off, at least by governments. And that has been a surprise. And I think it's one reason why markets rebounded so much in the spring and summer, just simply that worst case scenario of Europe firing their big trade bazooka, then Trump coming back with more tariffs. That's been taken off the table. Economists would say that's actually a very good thing, that governments don't retaliate for economic reasons. They do it for political and strategic reasons. But it is different from last time around and from what traditional trade policy says will happen.
Scott, when you say markets expect a taco walk back, is that basically just status quo of where we are right now on tariff rates and not the more than 100% that the president is threatening?
Yeah, I think that's right. It seems that everybody believes that there will be some sort of deal next week that will diffuse these tensions and foreclose that return to 150% tariff rates. Because along with that retaliation point I just said, another big reason that markets improved in the spring and summer is that the China craziness on tariffs was taken off the table. 50% is extremely painful for a lot of companies and consumers, but it's manageable. When you get to 150%, well, then you're just throwing up a blockade along with all the retaliation, and things get really hairy really quick. So I think that's one of the reasons why everybody's been so calm this time around, is they're expecting some sort of deal in that 100% plus getting off the table.
Have the Europeans come to the American rescue in the sense that they're now talking about using the anti-coercive tool to combat China when it comes to rare earths? And maybe China, as Jonathan's been saying, since this happened, overplayed their hand?
Well, it certainly does seem the case that the Chinese are getting pushback from more than just Europe, even. Really, a lot of governments are extremely concerned about this. And should the Europeans actually get their act together and move on this, it would be, I think, a pretty significant result and something that the United States would be pleased to see. But, let's face it, it'd be a lot easier for the Europeans and for others in the world to get on the United States side if they weren't also getting hit by Trump's tariffs. It makes tons of sense for the United States to build a kind of grand defense industrial base that involves our allies,
Scott,
including
hold on.
in Europe.
It's not just tariffs in the United States, though. China is hollowing out their industrial base, and Europeans are losing their jobs because of companies like BYD.
So you're saying that in terms of why the Europeans are upset?
Yeah, shouldn't they get alongside with the United States because China is eating their lunch, literally?
Well, they have to consider their options for both sides. There are benefits to trade with China in Europe, and the Europeans also have to deal with the United States that just isn't as friendly as they should be, quite frankly. It would be a lot easier, I think, for the Europeans to be more hostile towards China, to be more aggressive on trade with China, if they had a friend in the United States, if they had a more open and stable trading environment with the United States.
Meanwhile, Scott, it seems like President Trump is emboldened and thinks that a lot of the tariffs have given them a better position, has given the U.S. a better position when it comes to negotiation. And it appears, at least this morning, based on a slew of different messages, he's really focused on the auto industry. Haven't earnings that we've gotten so far from U.S. industries shown an incredible resilience? Just people shrugging off tariffs, not necessarily any kind of blowback that a lot of people were expecting just a few months ago?
Well, yes and no. It does show, I think, in a lot of these earnings reports, the kind of tremendous resiliency and dynamism, flexibility in a lot of our big multinational manufacturers. But you got to remember, first, a lot of these companies have received tariff exemptions. The auto industry is a great example of this. One reason why GM's tariff hit went down so much is that Trump gave them a big fat carve out when it comes to their tariff costs. The other big thing is, of course, they are passing on a lot of these tariff costs to consumers. And so they are able to avoid some of the tariff pain, but consumers are the ones bearing that. And then finally, there's still a ton of tariff costs for these companies that are, maybe they're not harming earnings overall, but they are adding pressure. I mean, GM, again, was still reporting $3 to $4 billion in tariff hits. The only reason markets liked that is because it used to be $4 to $5 billion in tariff hits. So there's still real costs here. It's just American companies are being quite good at moving the pieces around the table and avoiding those. But, small companies, they don't have all of those options. And you're still seeing a lot of pain among smaller businesses that don't have the carve outs, that don't have the supply chain flexibility, that don't have the long capital runways to deal with the tariffs like the big guys do.
So, Scott, look, I'm right there with you when it comes to things like free trade, open markets, and capitalism. But I happen to believe that the biggest problem with the global order right now is not the president's tariffs, it's Chinese overcapacity. And the fact of the matter is that even with these tariffs, China is still running close to a record surplus, potentially a record surplus for the year so far. And the rest of the world is going to eat that overcapacity. And that's what I think Annmarie's getting at here. The Europeans are going to have to respond on their own. I think they took for granted the fact that America would share the burden and keep sharing the burden with them. And Scott, they're not anymore. How do you think the rest of the world's going to respond?
Well, I think it's going to be a mix of actions because on the one hand, Chinese overcapacity is a blessing for consumers in these other countries. Getting cheap cars and electronics and clothes and other things is good for those folks. But other countries, of course, with that industrial capacity will respond like they often do. One of the big reasons, and that's with tariffs, I should say, because one of the big reasons why industrial policy can backfire is when you try to export your overcapacity, governments respond with things like anti-dumping measures and other tools. But the fact that the Chinese export machine has continued to hum in the face of massive U.S. tariffs really should tell you that unilateral tariffs still just don't work very well when it comes to dealing with these types of issues. You need a global coalition, and that's what things like the Trans-Pacific Partnership and other trade deals used to try to create, and that the United States really just doesn't seem very interested in creating except via a giant tariff wall.
Give it time, Scott. Maybe the Europeans get in line. We'll see. Scott, thank you, sir. Scott Lincecum there at the Cato Institute. From New York City this morning, good morning. The opening bout 2 hours away. Equities are positive on the session and on the week, up by 0.3%, 60 minutes out from a CPI report in America. As we count you down to the cash open, let's get you some morning movers and cross over to Danny for more. Hey, Danny.
Hey, John. Some gains from Intel this morning. Big gains, and should it sustain this pace throughout the day, Intel shares will have more than doubled so far this year. They had earnings after the bell yesterday, a really sunny outlook. They've returned to profitability. They have investments and stakes, be it from the White House, NVIDIA, and SoftBank, but also helping for their key business at the moment is the fact that there does seem to be around a rebound rebound in PCs, so shares up 7.6%. Ford also reported after the bell yesterday, a decent rally from them as well, up 4.2%. Yes, they took a $2 billion hit because of a fire at a key supplier of an aluminum factory, but they signaled they'll be able to push through that. And what's more, much like GM, their heavy trucks and their SUVs are selling very well. So shares up again more than 4% this morning. Also at the top of the hour, we got earnings from P&G. Those were also solid for the company, exceeding expectations. The things that did the best were their beauty and grooming products. It signaled that Procter & Gamble, their strategy of having a premium and have consumers pay up for that, it's actually working. So here's a consumer company where people are willing to pay more. They also said that they're able to have a less big tariff hit than they originally expected. So shares up 2.33%, John.
Danny, thank you. More from Danny in the next hour. On our radar this morning, the president and the Chinese leader meeting Thursday on the sidelines of the APEC summit in South Korea. The president saying direct talks are the best way to resolve lingering trade issues between the two nations. Elsewhere, Intel shares rising on upbeat earnings, the company beating third quarter profit estimates and forecasting fourth quarter sales will be around $13 billion. A sign Intel could be back on track after a very turbulent year so far. Target eliminating about 8% of corporate roles in the first major restructuring in years, the company cutting 1,800 roles across various teams, including 1,000 layoffs and closing out 800 open roles.
And this comes after really falling behind for a number of years after a number of issues with respect to inventories and seeing Walmart really take market share. They have a new leader. They're cutting jobs. People are going to wonder, what does this mean in terms of some of the bigger themes in terms of the job market? Does this mean that there's more to come? And the second question is, how much is hitting the white collar jobs, not necessarily those in the store, and how much is being replaced by artificial intelligence as part of some of the efficiency drive? None of those questions are really being answered. Nonetheless, definitely notable that this is the response to years of underperformance.
The consumer, the retailer, right now the trade story, you've got to wait until November 19th before the market, November 19th that morning, to get earnings from Target. This is the strange arc of earnings season. Get distracted by tech in the middle. That's what's really important. Towards the end, you start finding out a little bit more about retail America and where the consumer is.
And then in December, NVIDIA reports, and then we'll get a sense of what's going on there.
Sometime next year.
I think they're also the 19th, so more exciting, I think, NVIDIA than Target.
It is true, though, and you have to keep thinking to yourself, how much are each of these companies' specific stories, and how much are these representative of a larger tale? And there's a lot of jostling for market share going on here, and specific stories as well. So it's very difficult to sort of extrapolate a big theme from one company. Nonetheless, job cuts does raise some alarms.
Let's turn to trade. Some big moves in the commodity market. Big move yesterday, again this morning, up by 0.7% on both Brent and WTI. Chinese state companies cancelling some purchases of Russian crude. The move's coming after fresh US sanctions on Russia's two largest energy producers. Joining us now to discuss is Bloomberg's Javier Blas. Javier, welcome to the programme, sir. The president made a big move. We wanted to understand how China, how India would respond to it. Javier, what are you and the team learning in London?
What we are learning first is that everyone is taking a pause. Companies are reassessing their contracts, are looking at the finer wording of the sanctions, and they're also looking at what the White House is going to do, because one thing is announcing sanctions and another one is to wall the toll. Will President Trump allow prices to go much higher, and will be enforcing those sanctions strongly? History tells us that he will not. Neither President Biden nor President Trump have shown any appetite for high oil prices, and I think that that's going to continue. So there is a pause at the moment of taking more Russian oil, but that pause is a pause. We don't know what the companies are going to do next, and my expectation is that some of that oil is going to continue to flow.
Javier, if we do get secondary sanctions or less of these oils are flowing to India or China, who's going to step in and fill the gap?
The good news for President Trump is that there is plenty of oil in the market. OPEC has been increasing production. Saudi Arabia, the United Arab Emirates, Iraq, a number of countries in the Middle East have increased production in recent months, and they have announced their intention to continue increasing production. So there will be enough oil in the market, and that's why I think that the White House is acting now. They were not acting when prices were much higher earlier this year, but they are acting in a moment that we are heading into a surplus, so the market can easily absorb the heat if that heat really materializes and becomes a permanent heat, which I have significant doubts.
Well, what about U.S. companies like Exxon, can they also start filling the gap if they get higher oil prices? Will we see American companies start drilling again?
Well, American oil companies are drilling right now. It's not that they're going to be doing it again. They're doing now. And American oil production on a total basis, total petroleum production in the United States is running about 1 million barrels a day higher than last year. So U.S. production is increasing. So is also American demand for that oil.
Javier, always good to see you. It's been too long. Javier Blas there of Bloomberg in London on the latest energy moves. Ozan Tarman, the Vice Chair of Global Macro at Deutsche Bank, joins us now for more. Ozan, good to see you, sir.
Always great to be here.
Good morning. This could be an energy shock. What do you think this means for the bond market?
Well, even yesterday, that news kind of triggered around equities when you guys broke those news, because people got even more excited about Malaysia, what it may imply for the summit. Then some clients said that it affects only 30% of China purchases, but a signal is a signal. As for the bond markets, vigilantes have been quiet for a long time. No data didn't help them. Wonderful to be here on the CPI. They finally get something. So that may move things. And also 5% move in oil move things. Already because of that, we moved from 392 US 10-year to 4% flirt now. It almost wants to go. If majority of my clients, at least fast money clients, and Marcus Haidar, our inflation strategist, is right, if it's a beat, then we may finally get some movement on rates higher.
There's a lot to unpack here. Let's start on the oil, and then we'll go to CPI and the ramifications for market expectations for inflation. Do you think it's valid for people to take cues from the oil market and use that as sort of a signal of whether yields should go higher?
Not necessarily, but Lisa, they were dying for signals. So basically, volatility both for FX and rates are hit so hard that every single sign is hope for them. And for things like Europe, it is very important. Oil is more important. So if you, and it was one of the really working trades. Nobody really believed the Trump administration when they first said it's going to go below 80, then 70, now 60. So people are almost giving up. So that's one hope right there. And the others are shut down. Hassett, somebody very close to Trump, was saying it could be over this week. Well, I'm not even sure about November 1, but if shutdown ends, that's going to trigger rates a bit. CPI. There are some, when everybody gave up hope on this rates higher trade, and more importantly, when most people stopped out, now there are some signs that we may get some life.
This is interesting because a lot of people have come on the show and we've been talking about how it seems like the Fed's going to cut no matter what. And it's hard to see how high the bar has to be for CPI to come in that would actually prompt any second guessing by the Fed. What's the bar here in terms of what would trigger some of the bond vigilantes to come back to the table?
Pretty high. I mean, if anything, today on a 0.4, we would get a bit excited, but there's the other side of this as well. Even if we get in line, we may get a huge squeeze. So the bar is very high. Unless you get a very high number, this October cut is coming. And then because of this two-speed economy, K economy, Wallers of the world, West Ends of the world, they won the argument. Our friend Neil Dutta. So I think those 225s, in my mind, are almost automatic.
So this is the reason why a number of people have come out and said that actually the sell-off that you saw yesterday was a good indicator to get long because it didn't break above 4% for the 10-year yields, and you didn't see any kind of mass selling, even with a signal after so long of not getting anything. So what makes you not kind of pile into that trade, the idea that any backup is a buy, given the fact that there clearly is a lot of buying pressure and not a lot of concern for a longer run kind of inflation?
Don't get me wrong, I'm a dove. I'm loving this risk parity run, but I'm also my job is trading, right? So I do smell that when there is this lack of positioning, even a 0.4 can move things. But medium term, I think risk parity has the upper hand here. It's going to continue to give the pain trade. Dollar, that's interesting. Even when I was here last month, we started talking about it. Jonathan is right about the Europe trade. You know that the horse feels tired. UK, the stories aren't really working. The big hope for the soft dollar trade was Japan. Then Prime Minister Takaichi happened. Almost didn't happen. Now she definitely happened. So if anything, now yen is turning into a funder. So if the CPI is a beat, if anything, King Kong dollar may do even better against the G3. Emerging markets carry, that's different because volatility is low. IMF, DC, I was there in DC last week. Usually it's an orange sign when people are so bulled up. This time around, it makes sense for various emerging market stories. So EMFX can do well, but against the G3, King Kong dollar may have new life here.
Ozan, yesterday, the market move on oil was swift, up more than 5% immediately. Why was the market so surprised by what Trump did?
Because they are quite used to taco or whatever you want to call it. So they weren't really expecting this much of a shifting gears. They're all in a little.
But hasn't yesterday proved that you can't just taco this market?
Yeah, that shows you that market too can be surprised by the developments. And if anything, then the European summit, then this potential news, Bloomberg news on what China will do with Russian oil. Maybe they're shifting gears on Putin. Maybe they're raising the stakes on Putin, and that made the oil move.
You spend a lot of time with people on the buy side. What's the credible bear case right now? What have you heard? What are they saying?
We're both smiling, my Jonathan. So anti-prosperity is not on a good run. We need some surprises. Another thing that I brought up last time, and I'm still on it, tariffs and Supreme Court. Tariffs used to be the bad child, now they're the good child, they're the revenues. So these things, back to Lisa as well, these things almost pile up. I'm not even sure if we get a beat, but if my Haidar is right, if we get a beat, then shutdown ends, then Supreme Court, poly market gives 60% chance that Supreme Court blocks these tariffs. I don't think that's in the price. All of a sudden, I'm back into how Jonathan will open things. Maybe in November, middle of November, you open the show a little bit differently. I'm almost
bonds down, yields up.
Yeah, I'm almost talking for the Mets. I'm not talking for the home camp. I'm risperity, but I also need to smell what can make anti-risperity work again. And one thing is, all joking aside, now this trade is too empty. People gave up. Bears are giving up. That's always when you're most vulnerable.
You're sensing capitulation.
I sense and I see. I do see capitulation. Even in places like your ex-island, UK. I mean, what happened to the trust rate? 4 hours, and then Reeves is turning this game around.
Patience, my friend. Wait for the budget.
Wait for the budget.
Yes,
a lot of people are saying, and now at least you have cleaner positioning. On that, by the way, yesterday, some newspapers claimed that she may bring back income taxes.
I saw.
Guilds may love that. I'm not sure about the population. So that's, yes, for sure, November 26 stakes are very, very high.
It's the only tax hike she hasn't floated. Based on the reports in the British media over the past month, I think they've listed just about everything. It's good to see you, sir.
Very good to see you always.
Yeah, save yourself. Ozan Tarman there of Deutsche Bank. Thank you very much. Equity futures on the S&P this morning, positive by 1/3 of 1%, very close to all-time highs, despite all these volatile headlines over the last 2 weeks. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. President Donald Trump has terminated trade talks with Canada, citing a TV ad from Ontario. The commercial features excerpts of then-President Ronald Reagan defending free trade. The president is accusing Canada of timing the ad to interfere with the Supreme Court case you were all just discussing against his country-by-country tariffs. Arguments in that case are set for November 5th. Meanwhile, a federal sports gambling probe is rocking the NBA. Miami Heat guard Terry Rozier and Portland Trail Blazers coach Chauncey Billups were arrested and charged yesterday, along with at least 30 others, including current and former players and coaches across 11 states. The arrests are linked to 2 separate illegal betting schemes. The NBA has placed both Rozier and Billups on immediate leave. And Binance co-founder Changpeng Zhao, known as CZ, has received a pardon from President Trump. Trump told reporters he did it at the request of, quote, a lot of good people, though he has never met him himself. The move marks the latest act of clemency the White House has granted to a crypto entrepreneur, underscoring how the Trump administration has positioned itself as a friend of the industry. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate it. Up next, a bias to ease.
The Fed is going to cut almost regardless of what inflation print that we get. The only thing that could be a challenge is if you start to see the non-tariff related inflation, that super core services ex shelters start to kick up.
That conversation up next with Ashok Bhatia of Neuberger Berman from New York City. You're watching Bloomberg TV. Stocks are positive, higher by 0.3%. The data about 42 minutes away. The delayed September CPI report also gets some PMIs later on this morning. That's worth a look. The preliminary read for the month of October, a more timely measure, potentially, of what's developing in this economy. Equities on the Nasdaq 100 higher by 0.5. Similar story on the small caps. Under surveillance this morning, an easing bias.
The Fed is going to cut almost regardless of what inflation print that we get. The only thing that could be a challenge is if you start to see the non-tariff related inflation, that super core services ex shelters start to kick up. At the end of the day, the new Fed, the Fed that comes in next year, is going to cut to 3% no matter what. And they're going to ignore the inflation line of things. They'll focus on employment.
Here's the latest this morning. Delayed September inflation data due out at 8:30 Eastern Time. Investors widely expecting the Fed to remain dovish, even if we get a hot print. Ashok Bhatia of Neuberger Berman joins us now for more. Ashok, that begs the question, really. What would constrain the Fed's easing bias?
I don't think there's a lot constraining the Fed, at least till we get to 3.5. And, we're at, the current funds rate range is 4 to 4.25. So I think 2 to 3 eases from here. Our view is those are pretty much on autopilot. And then, the debate will start once we're closer to that 3.5 level. We do think one of the challenges for the bond market is there is a lot more priced in. You look at the bond market today, it's priced for the Fed to drop the funds rate to around 280 to 290. So a substantially further easing is already priced in, and that's going to create some tension, we think, in the bond market probably early next year.
Is that a bet on this Fed or a bet on the new Fed, the next Fed?
I think it's a little bit of both. I think, obviously the markets are wrestling with AI and, all of the, one of our key views is next year, we're going to be taking a step back from policymakers driving a lot of the markets and market narrative. And AI and the outcomes from AI are going to be dominant. And that could be what happens with the capital spending cycle. Does it slow down? Is there a strong return on investment? And also the labor impacts and impacts in the credit market. So we look at what's priced in, and there is some probability of how AI plays out, either with slower growth or disinflation. But your point, I think also that, over time, may not be in the spring, but over time, the Trump administration will have the opportunity to change more and more of the Fed and maybe drive to more of that 2% types of funds rate. That's probably not immediate, but definitely some of that's in the market too.
Ashok, in the near term, I just wonder how much you agree with what we were just talking about with Ozan, that the bears have capitulated, that increasingly they're throwing in the towel. The bond bears in particular, looking at a lack of hyperinflationary types of catalysts into next year. Does that make you a little more negative on just yields where they are?
I think our view is the front end is fully priced here. Now, I think one of the changes has been in sort of these 10-year and longer maturities. And as the funds rate comes down, a lot of these maturity points flip to be, in bond lingo, positive carry. It starts to be you earn income by extending a little bit of maturities out of cash. So, we do think the front end is fully priced here. We do think the long end and some of these longer rates, a lot of the negatives about government stimulus or government spending kind of getting to be in the price, at least near term. But, on the bear case, I would note in credit, we are starting to see, it is certainly not, and we're not predicting a big default wave or anything like that, but there are more and more cracks coming. A couple of the themes seem to be some of the slowdown in Europe, having some impact on credits there. Tariffs, we haven't been, I know you all were talking about tariffs and the Canada situation. That's starting to show up in some of the credit metrics too. So cracks might be a little strong word, but the bear case in credit selectively, we do think there's some issues of pressure rising there.
Can you pinpoint any particular pockets? We've already seen it in the subprime auto loans. We've seen it in areas credit tied to immigration in particular. I'm just wondering, Ashok, from your perspective, whether you're sussing out a greater degree of weakness in a certain type of fund or in a certain type of product than you think the market has really reacted to.
Yeah, I think there's been two themes. One has been maybe some smaller suppliers in goods chains that are, big companies are asking these smaller suppliers to bear the brunt of some tariffs, and there's pressure there. So that's one pocket that hits a number of goods industries. The other is the AI idea, and the market is gravitating towards this idea, particularly for the bond market, right? AI productivity gains, as a bond investor, will still just get back par, but it is creating risks for business models and such. And so, there's starting to be at the margin businesses, and this is across sectors, but maybe a little bit more in the software technology that the bond market can maybe envision this business being negatively impacted by AI, and some of those credits are trading a little softer. That, though, is more of, we'll have to see how it plays out. But we do think that's going to be a rising theme next year, too.
Ashok, you often hear people talk about a positive technical backdrop, the supply side story, issuance. This story that we dropped overnight, the banks are preparing to launch a $38 billion debt offering as soon as Monday to help fund data centers tied to Oracle. How much additional supply are we seeing? And does that have the potential to shake things up a little bit?
I don't think right now. So far the issuers that have been doing these mega types of deals, and Oracle's a good example of it. They have plenty of capacity to add debt to their balance sheets. So we would not say that this is worrisome changes in leverage ratios right now. We do think one thing we are paying attention to is there does seem to be a bit of shift of some of these investments that were internally funded by internally generated cash flow starting to come to the bond market. But, our expectation is these types of issues have been, well absorbed, and we just don't see that changing.
Is that the biggest counterpoint to the late cycle narrative, that we haven't seen the leverage story yet?
I think that is very fair. Like leverage ratios in the high quality areas of the non-investment grade markets, or that double B, the triple B, the investment grade. Companies have not leveraged up, and the leverage cycle has been on the government side. So we do think you could go through a period where the big tech issuers decide to put more debt on their balance sheet, and they are in a position to do so if they wanted to.
Ashok, appreciate it. Thank you, sir. Ashok Bhatia there of Neuberger Berman. Thank you very much. Equity futures, by the way, just spiking a little bit higher. Session highs up by 1/3%. That last point on leverage, I think, is a really important point. It's a strong counterpoint to this idea we're late cycle.
This is something that people have pointed to. You're not seeing the corporate leverage. You're not seeing the household leverage, because really it has come down significantly, albeit some pockets of stress. Where there could be leverage might be in other areas, which is the reason why people are looking at the darker regions of the market.
Up next on the programme, we'll catch up with Eric Friedman of US Bank, the former Fed Governor Betsy Du, Tiffany Wilding of PIMCO, David Kelly of JP Morgan Asset Management. 34 minutes away from the CPI data.
We're in that moment where we see downside risks to the economy.
It's problematic that inflation has been stuck at 3%.
We should be very careful about cutting into higher inflation.
The CPI report probably is going to be using more estimated results than normal. This data may not be as reliable.
The Fed is going to cut almost regardless of what inflation print that we get.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. For the audience worldwide, your third hour of Bloomberg Surveillance starts right now, and your CPI number is 30 minutes away. Equity futures on the S&P 500 firm up by 1/3%. On the Nasdaq 100 up by 0.5. Before the big one, it's delayed by several weeks, and we finally get at 8:30 Eastern time a read on inflation in America.
A ray of sunshine in a dark room at a time when we aren't getting any other official federal government data. This is what a lot of people are keying into. Big question for markets is how much will it matter if the Fed is already going to cut rates? And likely there will be a more dovish Fed next year. That said, especially I'm going off of what Ozan said earlier this morning from Deutsche Bank, this idea that you've seen a capitulation from the bears and this real feeling that maybe one headline could, at least in the short term, create a lot of volatility.
And I think it's going to create some headaches for this White House. Yesterday you had coffee at a record high. The president has been tweeting about cattle ranchers to bring beef prices down. Beef inflation has been rising over the past few months. And slowly but surely, especially ahead of the holiday season, where a lot of surveys, Dana was on yesterday talking about how they do see consumers pulling back. And they're unsure about exactly how much because of the tariff story. Now imagine from now until the end of the year, the government is still shut, and all we get is maybe hot CPI prints without any labor data. Day 24 of the government shutdown, and no one is blinking.
And the earnings are fine. Companies are dealing with it. Ford's up this morning by 3.6%. Earlier this week, General Motors rallied almost 15% off the back of earnings. Again, just to reflect on April 2nd, the weeks after that, we were sitting around the table. Where do you think GM's going to be in 6 months? Where's Ford going to be in 6 months? Ford and GM are doing okay.
There are two takeaways. Number one, adapting and adjusting, and how well companies in the United States have been able to do that. And number two, tariffs came down a lot. Expectations were for Armageddon, and this is someone who really tends to benchmark to a pretty extreme bar and then comes back from it. So all of a sudden, you have people who are coming out from the companies talking about tariff results that aren't nearly as high as what some people expected. It's all about the expectation.
There's been some reprieve on the tariff front to a lot of these auto sectors. Thank you to the auto lobbyists. I'm sure these CEOs are calling them all and paying those fees because they did get a lot of relief when it comes to the auto input costs of the auto parts. But John, Lisa, you guys have both been making this point. That's been a loss for the auto sector, the tariffs and some of the hits. But a win has been the emissions. And the fact that they're not going to have the same standard fuel emissions that they had under the Biden administration. So there's wins and losses that the auto space has been dealing with. The Trump administration, most important things, they've been resilient and they've been able to mitigate the concerns.
Earnings season doesn't really begin until next week. Wednesday, Thursday, a major chunk of the S&P 500 reporting across 2 days, a handful of major tech companies. Equity futures on the S&P this morning firmer by about 1/3%. Coming up this hour, the lineup looks like this. Eric Friedman of US Bank Asset Management. As stocks are trading near record highs, we'll speak to the former Fed Governor Betsy Duke with a key rate decision just around the corner, and Tiffany Wilding of PIMCO as we break down the latest inflation data. We begin this hour with stocks edging higher as traders await the September CPI report. Eric Friedman of US Bank Asset Management writing the following: we retain a bullish glass half full perspective into year end, thanks to a still optimistic view on both consumer activity and corporate spending trends. Eric joins us now for more. Eric, thank you, sir. From glass half full to glass half empty, what would it take?
I think it would be two things, Jonathan, and great to see you. I'd say number one would be an unexpected rise in interest rates. We are now in year 18 of the 10-year Treasury yielding less than 5%. That's a significant, let's call it, catharsis from consumers and from businesses that have not had to deal with higher rates. It's not in our forecast. We almost got to that 5% level back in April and early May. But again, the first shock we think would have to be higher interest rates. The second thing would be a rollover in consumer data. And as you mentioned, we've been more glass half full on consumers, not just the higher income spender, but also middle income spenders as well. One variable that's really important that I think is getting less attention is what is actually going to happen post-holiday season. One thing we're seeing consistently is this idea of keeping up with the Joneses. Because equity markets are really high, because property prices are up, there may be this push through to holiday season, but we have to pay attention to what happens on the other side of holiday season. We as a bank love it when people pay us back for credit. So again, making sure that consumers are spending responsibly will be important. Likely a push through to the end of the year. What happens in Q1 of next year we think will be really, really important.
Eric, are you getting paid? That's a key question. Not you personally, of course, but are you seeing the banks getting paid? Are we meeting those repayments monthly?
Yeah, we are. I think if you look at even the bookends of consumer credit, U.S. Bank has a very strong credit base. If you think about other banks that perhaps moved down a little bit further into the lower quality credit spectrum, they're actually seeing some modest improvement. You heard that from a number of banks last week as well. So certainly there are issues of delinquencies. Student loans is a new expense item that consumers are still adjusting to. Auto loans is not new. That's been something that's happened for some time in terms of there's being some issues in that credit schema. But in general, we think that delinquencies are somewhat healthy. Actually, there's a decent, look at that across FICO scores. So in general, we think that there are responsible payments being made. But again, to your point, Jonathan, we can't extrapolate that will happen on into perpetuity. If we get a softer labor market that permeates, that would certainly leave us with some concerns about consumer strength.
There are a lot of ifs about how things could go wrong. There haven't been that many fears recently about how things could go so right that we suddenly see a reacceleration in inflation. Are you in that camp as well, that really today the CPI report will be interesting, something to study for the history books, but not necessarily something that will really get you thinking more materially about price instability?
Yeah, Lisa, I think you framed that perfectly. I think if you look at this upcoming CPI data point, this will be a pick your narrative number. We think if it comes in really hot, I think people will say, hey, that's kind of a kitchen sink number and the data is a little bit messy. If it comes in low, we do think that the Fed, as well as a lot of investors, are using that function in Excel called a round down, meaning if they see something with a 2 in front of it, they say, hey, that's actually a really bullish number and that rates do have, pathway lower from here. So we think the key point, if you look through the cycle, even out to May and June of 26, Lisa, you're still seeing CPI headline estimates at like 3.1% for the US. That's very different than rest of the world. So what I think that says is that markets can't really forecast tariff policy very well. And I don't say that in a begrudging fashion. Look, and Annmarie nailed it yesterday. You think about what's supposed to happen between the US and Russia this week. President Putin and President Trump are supposed to have a cup of coffee by the Danube in Budapest, and it didn't happen. In fact, we saw 2 sanctions on major oil companies in Russia. And you look at, obviously, the overnight news with Canada. So this is let's call it a price taker's market with respect to tariff policy. We do think there will be a more conciliatory outcome with respect to U.S.-China relations, but no one has a definitive edge. And so, again, estimates are still keeping a margin of error with the thought that inflation remains high because of tariffs remain a bit stickier than perhaps we thought a couple months ago.
Eric, is there an inconsistency of investing in real assets tied to the AI build-out, to the new economy, and also bet on disinflation, especially given the fact that commodity prices will likely rise in response to some of these investments, and you will see a certain degree of price pressure coming from just how much investment is going into some of these areas?
Yeah, I think, not to make a shameless plug to David Gura, who had a very, very thoughtful podcast on this point with respect to this to call it loggerheads between AI data center build out and utilities in cities like Memphis, Tennessee, and other parts across the country. But that's a really important concept, is that we are seeing a land grab. And again, as an industry, we always do this. We always overbuild, if you will. And at some point, you have this, this real concern between consumers and everyday residents that are maybe happy to see some more industry coming to their town until they realize that there's not a lot of net new jobs occurring, but costs of utilities are going up significantly. So the way that we're thinking about infrastructure, we're more interested in like the transmission of hydrocarbons and moving petrochemicals from point A to point B. That we think has some embedded inflation contracts within. We don't think that there's a great edge in what's going to happen with the spot price of oil. In fact, we think that oil probably has more downside than upside in the very near term. So I think, Lisa, to your point, this is really more about understanding how the ecosystem will work as opposed to making bets on what may happen with individual commodity prices. That's the way that we're thinking about real inflation and real assets in the here and now.
Eric, what happened this week with Russia, does that show that the market might be just too complacent going into the talks with Beijing?
Yeah, I do think so, Annmarie. You think about 2 Fridays ago where we had a back and forth in the headlines between what was happening with the potential talks between Xi Jinping as well as President Trump, and President Trump saying, we may not actually get together. There was that kerfuffle, if you will, on rare earths. And yet a 2.1% down day with a massive VIX spike. And that, I think, goes back to the notion of, we on the street feel like, and obviously we on the buy side feel like we can forecast certain things. No one can adequately forecast policy with respect to the back and forth with these major trading powers. And again, CFOs, I think to the point that Lisa made very elegantly earlier in the show, CFOs are still very cautious about making definitive decisions. We see it in our survey data. We see it when we talk to companies. CFOs are like, look, we're not sure how sticky and how durable tariff policy may be. Look at what's happened with automakers. Again, I think you've covered this very well. You've seen a consistent thought about EVs. That landscape has changed, as well as tariff policy that has made a significant bottom line difference for companies like GM and Ford. So those are the sorts of things where I think the market tends to react, if you will. The underlying thesis on consumers and business spend is positive, but we all recognize we're price takers on policy with respect to trading, and that's why there's much more of a reaction heading into what may come out in the next couple of weeks.
I'd love to know how you're thinking about the potential reaction, Eric. If we get a messy meeting next week, is that still bond bullish? Because that's a big shift from where we were back in April.
Yeah, we think it probably is bond bullish, Jonathan, but probably the more immediate reaction function would be very stock negative. And, I think that we've done a good job as an industry of thinking about this broadening out theme. Will we see not just the hyperscalers participate in equity upside. If we do have a messy meeting, then that narrative gets a lot of cold water thrown at it pretty quickly. I do think the big question we have to ask ourselves as bond market investors is, again, how will this play out in actually the auction market? And I know that Lisa pays attention to them. We pay attention to them as well. And so that notion of supply and demand, I think that Bessent really understands that the bond market will not accept a lot of supply on the long end of the curve. So to your point, I do think it would be potentially, a bond bullish outcome, if you will. But I also think that the Treasury in particular has to be very smart about where issuance comes, because the market may not be very interested in long duration fixed income. It may be more belly of the curve and short duration maturities that the market has more appetite for.
Eric's getting paid. That's my takeaway from this. Eric Friedman of US Bank Asset Management. Eric, appreciate it. Thank you, sir. Bond yields have had quite a rally. We're down about 80 basis points from where we were in the middle of January. That's quite a move. This is a big move too as well this week. Crude higher by more than 8% on Brent so far this week. 4 consecutive days of gains, potentially the biggest weekly incline we've seen going back to June of 2025. It's quite a move.
No one was expecting Trump to come out and go after the two major producers, Rosneft and Lukoil, and he did. The start of the week, we were talking about maybe taking flights to Budapest to go to this Putin-Trump meeting. No, he doubled down. Huge sanctions. Rhinestan is talking about 500, 600,000 barrels coming off the market because of this. This is why everyone is very complacent going to next week. But Trump doesn't always chicken out, and he has an incredibly high pain threshold. And if he doesn't get what he wants out of that meeting with China, potentially it can get messy.
Brent crude 66.42 with an update on stories worldwide with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Shares of Procter & Gamble are rising 3.3% in the pre-market after the company reported better than expected sales in its latest quarter as consumers brushed off higher prices. P&G reported 2% organic revenue growth for the period, with earnings per share also topping expectations, led by growth in the beauty and grooming categories. Meanwhile, Anthropic has confirmed a cloud partnership with Alphabet's Google. Google will supply up to 1 million of its specialized AI chips to Anthropic in a transaction valued at tens of billions of dollars. The arrangement boosts the AI startup's computing capacity while reinforcing Google's role as a major investor and key infrastructure provider. And in a political U-turn, New York City Mayor Eric Adams has endorsed Andrew Cuomo for mayor, calling frontrunner Zohran Mamdani a snake oil salesman. This comes just weeks after Adams himself called Cuomo a snake and a liar. That's politics for you. The move is seen as an effort to boost Cuomo's campaign less than 2 weeks before the November 4th election. That's Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Watched the basketball game earlier this week, didn't they?
Yes.
Court side of the Knicks.
So Cuomo left the debate after it's quite fiery and went to the Knicks game to sit down with Eric Adams. And the next morning, Eric Adams is endorsing Cuomo.
There you go. Just like that. Basketball. Things happen. Apparently other things happen too, but we'll get to that story another time. Equity futures on the S&P 500 firmer by 1/3%. Up next, the morning calls, plus the former Fed Governor Betsy Duke with a key rate decision just around the corner. That conversation up next, live from New York City this morning. Good morning.
The sources of inflation, I think tariffs will still carry some more upward pressure, perhaps not as much as people had originally thought, but I think it's still going to be a factor. The Fed has to be aware of that. And I think that has to be in their calculation. But I think they're under pressure to cut, and I think they will tend to do that unless we have an upward surprise in that inflation number.
It would have to be a monster surprise in about 13 minutes' time to change that story. That was the former Kansas City Fed President Thomas Hoenig there on the inflation report. That inflation report is just around the corner. Your scores into it shaping up as follows. Equity futures up by 0.3% on the Nasdaq, up by 0.5. That's the price action. Let's get you some morning calls. First up, JP Morgan raising its price target on Intel to 30, citing favorable customer demand. Second up, Wells Fargo raising its target on Ford to 11, highlighting better than expected tariff guidance. And finally, Goldman lowering its target on Deckers to 81, citing weak revenue growth in the US market. That is one of the worst performing stocks on the year so far. For the S&P 500, Deckers in the pre-market is down by about 12%. Let's turn to the data as we count you down to CPI. The former Fed Governor Betsy Duke writing this: even if the tariff effect proves transitory, inflation is likely to be at 3% or higher for more than 5 years. Betsy joins us now for more. Betsy, welcome to the program. Before we even talk about today's number, what does that say about the credibility of the Federal Reserve that we're going to be so above target for so long?
I think it says a lot about the credibility, which is why I think it's a mistake to ignore where inflation is right now. If you look at where it's been and the Fed, it has been stationary or stuck for over a year now at 3% or higher. And so it's hard to argue that monetary policy is too tight.
At this point, though, Betsy, couldn't you argue that it's okay, that actually it's fostering that a 3% inflation rate has been in some ways beneficial for certain aspects of the market?
It may be for the market, but the thing is, the credibility of the Fed is based on anchoring inflation expectations. And most people can't really accurately tell you a percentage of what they expect inflation to be, but they begin to build in sort of, what recently was is what they expect. And if you have 5 years of over 3%, the expectations just instinctively are going to be for higher inflation.
Right now, there seems to be this feeling that artificial intelligence is going to solve everything, and that come next year, you're going to start to see productivity increases that really triumph over any inflationary forces. How much do you think that that's factoring right now into the Fed's calculus?
I don't think you've seen that yet, and I don't think the Fed is counting on that at this point to bring inflation down.
Well, when it comes to AI, though, at some point, how do they address this when maybe it's not even an inflation issue, it becomes a labor market issue?
I think the labor market is going to get really difficult to judge because of mismatch in workers and jobs. So it seems that AI is impacting job market for particularly new college graduates. But those new college graduates are not likely to take the jobs that are currently unfilled because of deportations and reductions in immigration.
Betsy, how difficult is this moment for the Fed, and maybe not next week, but in the months coming, if we remain in a government shutdown where day 24, no one's blinking, and we might continue to get CPI reports because we have to in terms of what it means for Social Security checks, but we might not have labor data?
I think this is actually the reading that matters for Social Security checks. So you may not even get inflation data going forward. The Fed will just have to deal with the data that it can get. And there is a fair amount of private sector data that's available. It won't be as good, but I think it will give them enough to be able to judge sort of generally where we are. Frankly, I don't think monetary policy is what's driving the economy right now. It is much more driven by fiscal policy, the great big beautiful bill, currently the government shutdown, tariffs, immigration, deportations. All of these things, as well as just the uncertainty and unpredictability of policy right now.
So, Betsy, I think that final point is a really, really powerful one. And it's something Lisa's asked quite a few times. The Federal Reserve is cutting interest rates, responding to this massive downshift in payrolls. I think the question worth asking is what difference are those rate cuts actually going to make?
I agree. And I think the Fed would be well served to be very cautious in this environment.
Betsy, do you think they will be cautious in this environment? They've basically managed to cover up differences on the committee at the moment by calling these risk management cuts. Now, they're risk management cuts that come with their own risks. And Betsy, do you think that's going to come to the surface, not at this meeting, but maybe at the December one?
I think it might come to the surface at this meeting. I think you might see dissents on both sides at this meeting. The reason I say that is because this meeting sets a pattern. So if your pattern is quarter point every meeting, that's hardly a cautious pattern in my mind.
Going forward, do you think that right now there is any reason to think that this Federal Reserve could actually become more hawkish in the near term? Or do you think that ultimately it's going to come down to the long end of the yield curve and how much it's going to respond to exogenous factors and be the discipliner, if you will, on the market?
I don't know how how much the market is going to pressure the Fed. Because if you start setting up an expectation for more and more cuts, at some point, the majority of the Fed voters are going to feel uncomfortable with that pace. And then it's going to appear to be a hawkish turn, although it may not actually be if you'd been in the room for the entire discussion.
Betsy, this was thoughtful. We appreciate it. Thanks for being with us. The former Fed Governor, Betsy Duke, just ahead of that CPI data, 6 minutes away. That point on inflation is an important one. You have to remember why we're going to see the CPI data in about 6 minutes' time. Raises questions about when we'll next see CPI.
Because these workers were brought back, deemed essential, to make sure they could find out what's going on with inflation for Social Security checks and the cost of living. Are they going to remain on staff for the remaining of the CPI reports, or are we going to go back into full blackout? No CPI. We're definitely not going to get labor market report either.
Mike McKee's going to break down the number for you in just a moment. He's got a quick preview. Mike, what are you looking for in 5 minutes' time?
We're looking for inflation, John. Right now, analysts are expecting a still strong inflation report for the month of September. Really no change from August. A 0.4 rise in the headline number, a 0.3 rise in the core. Puts both of those on a year-over-year basis up over 3%. Betsy Duke, not kidding. It is a long way from 2% and going the wrong direction, which is why you have to worry or wonder about what the Fed is thinking. We do have one other set of economic data I want to point out to you guys. The Labor Department puts out the collected unemployment statistics from the various states, and we have taken those and we have seasonally adjusted them. And basically what we're showing is that 227 last week after 220 the week before, continuing claims up just a little bit. Now, some states are missing their data, so we had to impute them. But basically, we are getting unemployment initial claims, and the Fed is being able to do the same thing and showing that we're not seeing a labor market problem yet.
Mike, thank you, sir. Mike McKee's going to have the numbers for you in just a moment. I thought maybe October's too soon for there to be some real division at this Federal Reserve. Betsy Duke thinks you might see it next week. Coming up on the program, September CPI, moments away. From New York City this morning, good morning. So we had to wait a while. This is it. Seconds away. CPI data in America. Your scores heading into that data look like this. Equity futures on the S&P 500 up by 1/3%. On the S&P, on the Nasdaq 100 up by 0.5. Heading towards a second consecutive week of gains in the bond market. 2-year, 10-year, 30-year bond yields higher in the last 24 hours. Up again this morning. 10s at 4, 30s at 4.59. For your economic data for inflation in America, here's Mike McKee. Good morning, Mike.
Good morning, John. We have a little bit of good news here as headline inflation comes in up 0.3 on the month. The forecast was for 0.4, and core comes in up just 0.2%. Forecast was for 0.3. We're still at 3%, though. Instead of 3.1%, as was forecast for both numbers, we get a 3% handle for both headline and core in terms of where we are for the total month here. We're going to have to check out the overall numbers here, but let me give you a few before we check the markets. Food prices, and this has been something that people have been worried about, only up 0.2 after being up 0.5 in the month of August. Energy prices in terms of gasoline up 4.1%. That added to inflation definitely. It was only up 1.9% the month before. And here's something good. Car prices. New vehicle prices up just 0.2%. We thought we might see a jump because of the new models coming in. Used car prices are down 0.4 on the month. Apparel, though, a big rise, 0.7 during the month after 0.5 the months before. Services were up 0.2% during the month, and goods up 0.2%. So inflation restrained, Fed is a go.
Mike, that is what we call the right kind of downside surprise on headline and on core. Headline inflation comes in at 0.3, the estimate in our survey 0.4. Core CPI month over month comes in at 0.2. The estimate in our survey, 0.3. Off the back of that, push it through the bond market. 2-year, 10-year, 30-year bond yields declining, as you might expect, particularly at the front end of the curve. We're down by 4 basis points to 345. Take the bond move, push it through foreign exchange. What have you got? Some dollar weakness, euro dollar up to 116.40. And ultimately, with that kind of yield move, equities up by 0.7% on the S&P 500 and some outperformance, some big outperformance on small caps. Bramo up by 1.6%.
That was exactly where I went to, this idea of how much this is going to help some of the smaller and mid-sized companies that really have been more significantly affected by higher rates. This is a clear signal to the Fed that they can go for 25 basis points. My question is, how long before we start to see some analysts saying this means they can go 50 or something of that nature? Not clear that that's exactly what's being priced in, but definitely a sigh of relief.
And Mike, I'm sure you've got another take on the data, but I've got another question on the Federal Reserve. And if we can deal with that up front, I think for many people, this data this morning wasn't going to change whether the Fed will or won't go next Wednesday. Does it give them a little bit more space to guide beyond October when the chairman sits in that news conference and addresses you directly?
I don't think it really does, in the sense that we are flying blind right now in the month of October. And when they get to December, they may not have any October data, and who knows whether they'll have November data. So at that point, they're really not going to be sure of where we are with inflation. And they're certainly maybe not going to know within a reasonable guess of what happens with labor market. So I think you have to assume that December is going to be up in the air until at least we know when this shutdown ends and data starts coming back in again. Things we want to note here for you in terms of prices. Rent of shelter, we're talking about here the overall housing numbers that play into services. Up by just 1.4%. No, I'm sorry, I'm reading the wrong one. By just 0.2, which is good news because shelter has been coming down. Owner's equivalent rent up just 0.1. I don't have the comparison, but that is the lowest in many, many, many months. And remember how last year we were always worried about when would housing come down. So as I mentioned, we're also seeing gasoline prices were up a lot. Food prices up 0.2. Food at home up 0.3. So still a little bit of inflation at the grocery store. Motor vehicle insurance down 0.4. That was one that was rising big. So it looks like we've seen a kind of a rollover in inflation. Airline fares up just 2.7%. They were up 5.9% in the month of August. So inflation has rolled over, at least in the month of September. And this is good news for those who want a Fed rate cut.
Mike, I feel like we're out of practice. It's been so long. Mike McKee, thank you, sir. Some economic data to go through. Yields take another leg lower at the front end of the curve. We're down by 5, another leg higher in the equity market. You can see that across the board there on the S&P, on the Nasdaq, on the Russell. If you turn briefly to foreign exchange as well, just a little hint of dollar weakness and some euro strength. Data out of Europe was pretty good as well this morning. Eurozone PMIs, one of the best reads we've seen going back to 2024. Look out for the US PMIs a little bit later on this morning. If you are just joining us, a downside surprise on headline and core CPI, unlocking some lower bond yields this morning, going into that Federal Reserve decision next Wednesday. Joining us now to discuss is Tiffany Wilding of PIMCO. Tiffany, welcome to the programme. Is this a source of comfort for this Federal Reserve next week?
Well, I mean, I don't know. I mean, I think certainly it's good news on the inflationary pressures, but the argument that we've been making, which I think is symptomatic of this report, is that the economic adjustment that we're seeing to tariffs is coming through less on a price adjustment. And instead, companies are finding ways to defend margins by offsetting other costs. And I think the fact that you saw another headline this morning around a large retailer, that is doing, some layoffs at the, kind of higher executive levels, that's just in our minds symptomatic of that they are finding these other ways to cut costs. So, what that means for the Federal Reserve is that there is some downside risk to the labor market here. So I don't know that they should be, completely, taking a sigh of relief here. We need to see the labor market data, obviously, when the government reopens. But as you and Mike mentioned, we do think they cut in October. And of course, the median expectation from the Fed is that they'll cut again in December.
How much of a forward look can they give us at the October meeting, Tiffany? When Chairman Powell goes into the news conference, he doesn't have much visibility on anything right now. How much guidance can he offer us for December and beyond?
Yeah, I mean, I think it's incredibly tricky, and I'm not sure that they will offer a lot of guidance. I think they're going to say that we don't have a lot of data to go on here. There's private sources of data, but even there, it appears that some of the Fed's, the previous sources of private data that they got in the labor market, maybe they're not getting anymore. So it is a much more tricky situation for the Fed. They're going to be looking at markets and and I think the news flow in order to kind of figure out what's going on here. And I think it's going to be really tough for him in terms of guiding any further.
Tiffany, a lot of people have been looking at the housing market in particular as a sign of disinflation going forward. And one thing that Mike pointed to is owner's equivalent rent. Looking at this, it just looks like inflation in owner's equivalent rent has fallen to the lowest pace going back to 2021 with a pretty big decline, which is one thing that's giving fuel to some of the enthusiasm in bond markets this morning. I'm just wondering how big of a tell that is for you.
Yeah, no, I mean, I think that the normalization in housing and rents is something that, the economics community has expected for some time. And I would argue that it's delayed. And it was delayed because we saw a really big immigration boom over the last couple of years. Now, obviously, that the immigration policy has taken a big U-turn, you're not seeing those tailwinds of additional population coming into the United States needing housing. And as a result of that, you're seeing rents cool off quite a bit. So I don't think it's that surprising, but I do think it's, one of the things that should give the Federal Reserve comfort, that they, that inflationary pressures outside of, some tariff-related pass-through are pretty benign at this point.
Given the fact that we're seeing no inflationary pressures to note that really are even beyond what people expected, and you are getting these announcements, you were talking about the Target announcements without naming them, laying off about 1,000 people and removing 800 jobs from their listings. We also saw GM announcing a round of job cuts this morning. I'm just wondering how much these are just anecdotes and typical versus something that really is a softening that is behind the disinflation as well as the concerns that the Fed has about the labor market.
Yeah, I mean, again, we think it's very symptomatic of how we see the economy that's ultimately adjusting to tariffs. I think the really big surprise this year coming into the year and thinking about tariffs is that you'd get some price level adjustment. And there's multiple ways that companies can adjust to this. And I think what we're learning is that, they're not fully adjusting prices and that they're trying to offset costs in other ways. And I think the fact that you're seeing this AI investment boom and some broadening out just in the diffusion of AI technology, companies are hoping to get some labor saving cost benefits here. And investing in capital because of the tax, the new tax law, the One Big Beautiful Bill Act, gives you pretty big, tax incentives with upfront capital expensing. So I think companies are really just making this adjustment, more so through the labor market. And in terms of the Federal Reserve and their mandate, that just suggests that they have more room to start to adjust policy back towards neutral. If they do cut 2 more times this year, they would be, 3.5, which is kind of the upper end of the range of neutral estimates that they have. And so getting back there and making that adjustment, seems very reasonable to us, just given the information that's coming in.
Tiffany, when you say labor saving cost benefits, should we all be expecting more layoffs then to be announced in 2026?
Well, I mean, I think the economy will need to go through an adjustment as a result of, these transitions that we're seeing, whether it be, the policy related transitions this year or, this tech. Sort of tech transition that we're seeing. It does seem like AI is moving pretty quickly. I think it's still uncertain how much productivity gains we'll actually get and how that will save costs for companies. But I think we are starting to see the effects of that. I think you could start to see it at announcements, layoff announcements as well at some of the tech companies. It is displacing some workers. Now, I think what's harder to understand is, eventually importantly, it will also create new jobs. And how quickly will that happen? And what those new jobs will be is more difficult to forecast. But I think at least in the near term, you will see some labor saving, displacement here. And the companies need that and are forced to try to get it because they have more tariff-related costs.
Tiffany, thank you. Tiffany Welding there of PIMCO. It's why so many on the committee right now are prioritising the one side of the mandate. To take stock of things, though, unemployment in the low fours, headline inflation still at 3%. There's a lot of people out there still asking the same question. There's some hawks on the committee. They'll say the same thing. What's the rush? Why go again?
And the Fed's still going to cut rates, so they can ask questions all that they want. And ultimately, how they justify it is going to be that we are at restrictive areas, so we have some room to have these insurance cuts. You are asking the right question about long term. Can they signal beyond that level, those easy insurance cuts, about how far they can cut into just what a lot of people can't determine is the neutral rate?
It gets harder, that's for sure. Equities roll over just a bit after spiking, still positive by 0.5%. In the bond market, off the back of the right kind of downside surprise on the CPI report, yields are a little bit lower, but off session lows. We're down 3 or 4 basis points now on 345. Let's give an update on stories worldwide with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. President Donald Trump has terminated trade talks with Canada. The president posted on Truth Social this morning. Canada took a big buy ad saying that Ronald Reagan did not like tariffs when actually he loved tariffs for our country. Ontario Premier Doug Ford responding on X, writing, Canada and the U.S. are friends, neighbors, and allies. President Reagan knew that we are stronger together. Meanwhile, this just in, General Motors is laying off more than 200 workers, mostly affecting tech center employees in Warren, Michigan. The cuts come just after GM raised its profit guidance for the year earlier this week. The news also follows a post in the last hour from President Trump, who touted the positive impact of tariffs on the company. Shares are up nearly 1%. And the Trump administration is preparing a proposal to open almost all U.S. coastal waters to new offshore oil drilling, despite opposition from state governors. Sources telling us here at Bloomberg that the draft plan for selling oil leases includes waters near the southeast U.S. that President Trump tried to close off while campaigning for re-election 5 years ago. That's your Bloomberg brief. John.
Yahara, thank you. Appreciate it. Thanks for this morning. Up next, we'll catch up with David Kelly of JP Morgan Asset Management as we break down the latest CPI data. Plus, Danny's got some morning movers. Beyond Meat, up on a revenue beat. That stock is higher by 11%. The open about 43 minutes away, and we're looking to add some weight to this rally this morning. We're up by 0.6% on the S&P, on the Nasdaq up by 0.9%, on the Russell. Small caps up by 1.6% following a downside surprise on inflation data. Up on the week, up on the session with your morning movers. Here's Danny. Hey, Danny.
Hey, John. It's the poster child for the meme stock rally renewed. Beyond Meat, the company that's up more than 300% so far this week. Finally, some fundamentals to trade on. Beyond Meat reporting earnings, EPS coming in better than expected. It's a company that, again, fundamentally has been struggling, giving a pullback in some of the meat alternative products that they've been offering. But the earnings come in better, so you get this renewed bout of buying, up 11.6% in the pre-market. Shorts still exist in this company, so there still is more room for a short squeeze. Elsewhere in earnings, the big one after the bell yesterday was Intel, and what a result it was. A sunny outlook from Intel, a return to profitability given all of their partnerships, but it was the old school business, not building out AI. It was PCs that seemed to really be benefiting them. We also got earnings after the bell yesterday from Deckers. Not so sunny. Shares falling 13%, the maker of UGG and Hoka, cutting their second half outlook. The CFO getting on the call and saying it's a consumer that's a little bit hesitant. They feel the price raises from tariffs and they are pulling back because of it. They did say they had about $150 million impairment charge from tariffs, but they are working through that, trying to mitigate some of the costs. John.
Danny, thank you. Looking forward to the coverage. We got a consumer problem or a Deckers problem?
I think it's a Deckers problem.
Based on the year so far, without a doubt.
People are kind of, I think, over Uggs, and they're not buying Hokas. I think Hoka, the top was when Biden wore a pair of Hokas with his suit.
I said the same thing at the time.
It just wasn't that cool.
Not great for the brand. Once you start becoming that, like for older people with problems with their feet.
Like when boomers were starting to wear Skechers, it was over.
It was over. The kids aren't going to be interested. Equity futures on the S&P up by 0.6% as we count you down to the opening bell. Let's get you the trading diary. Some more data later. Look out for some PMIs, UMich consumer sentiment. Next week, though. Wow, next week. Next Wednesday. Federal Reserve interest rate decision, Chairman Powell news conference, earnings from Microsoft, Alphabet and Meta. On Thursday, the president meets the Chinese leader in South Korea and more tech earnings from Apple and Amazon. Next Wednesday and Thursday, absolutely humongous. This morning, the focus is on inflation. CPI coming in below expectations. Traders adding to bets for 2 more rate cuts this year, including 1 next Wednesday. David Kelly of JP Morgan Asset Management joins us now for more. David, let's start with the inflation data. Is 3 the new 2? And is it going to stop this Federal Reserve from cutting interest rates?
Well, I think the Fed's going to keep on cutting rates. It's generally a better than expected report, but I think what it really shows is we have a K-shaped economy, and it's sort of a K-shaped CPI report. The thing that really jumped out at me is, first of all, rental costs coming down. There's, we've got a big change in demographics here, and rental inflation is just going away. You also saw used vehicle prices fall. I thought that was pretty interesting. And then the big thing here is core goods prices outside of food and energy. That's the stuff that should be hit by tariffs. But that's only up 0.2%, up 1.5% year over year. It is clear that mainstream retailers don't believe they can pass on the tariff increases right now. And that's what's making this inflation rate a little bit tamer than people feared.
David, doesn't this just justify what the market's already sussed out, which is that inflation fears were overblown earlier this year? The Fed can keep cutting, potentially below 3% by the end of next year, and that it's not going to cause a huge inflation problem?
Well, I never thought we had a long-term inflation problem, but I think it is still early days on the tariff effects. What's going to happen is, right now, retailers feel like they can't pass on the price increases. But early next year, you're going to have this refund bonanza. The average income tax refund per household, we believe, is going to be over $4,000. Last year was $3,200. And that is the exact time when retailers are going to feel like they can pass on these tariff increases. So I do think we've got a little bit of a spurt in tariff inflation still to come. But then, if nothing else happens, there isn't a lot of momentum in this economy, and it'll slow down again and it'll cool down again. So I don't think we've got a long-term inflation problem. My real question is, given how bubbly financial markets are, do you really need the Federal Reserve adding more liquidity to the party right now, or should they just hang on in there and say this is enough liquidity?
What are you saying, or what are you seeing that really is bubbly, given the fact that earnings have exceeded expectations, the forecasts have exceeded expectations, and we're likely to see more of the same next week with the tech earnings?
Well, valuations are extremely high for the over. Now, obviously, a lot of it's concentrated in the mega cap stocks, but also profits as a share of GDP are extraordinarily high. So overall, the total value of all U.S. market cap is about 365% of GDP right now. It was about 212% before the tech bubble burst back in 2000. It was 87% before the 87 stock market crash. So there's it's leverage upon leverage, high PE ratios on a very high level of earnings relative to GDP. Now, I still think this is a very good economy for equities, but I wouldn't say that you could call the market depressed at this stage. I think that one of the dangers here is that everybody gets out over their skis, and then you have a significant market correction or a bear market.
So are you talking about potentially, if the Fed is cutting into strength, they'll be making an error this month?
Yeah, because it's a different economy, and we keep on talking about, the Fed's going to tighten to lower inflation. Forget about it. The Federal Reserve's short-term interest rates are not impacting growth. They're not impacting inflation, but they are impacting financial markets. And the big problem that we've had in this century of the 2000s hasn't been CPI inflation getting out of hand. It's asset bubbles, whether it's housing bubbles or tech bubbles. And the Federal Reserve should not be in the business of blowing up bubbles. So I think they should, just take it easy. I don't mind if they cut rates a little bit here, but I certainly would have a problem if they cut rates below what they think neutral is, if the economy is not threatened by a recession, because we are seeing money go into financial markets, go into financial assets, and just not come out. And it's kind of like a stuck valve. And the more money goes in, the more this market just seems to accelerate upon itself.
David, we asked Governor Waller this question when he was on the programme last week. We asked whether he was getting lulled into cutting interest rates and potentially juicing financial markets. David, do you think there's a problem with their interpretation of the dual mandate, or just the dual mandate?
I think the dual mandate itself. I think that Congress needs to recognize that monetary policy has significant impacts on financial conditions, and therefore maintaining stable financial conditions should be part of the goal. It's kind of like with the ECB, who for years decided they weren't supposed to intervene if one particular country got into significant economic distress and destabilize the euro system. And then finally Mario Draghi said, look, if Greece is a problem, we got to do something about Greece. Well, this is a similar situation where the mandate needs to be expanded a little to recognize the impact of Fed policy on financial and other asset price bubbles, to try to prevent bubbles or busts, because of course that's what a bubble creates a bust, and you want to have financial market stability, not just economic stability. And I think the Federal Reserve can have an impact on that.
David, this was thoughtful. We appreciate your time. David Kelly there of JP Morgan Asset Management. An important question about the Fed's dual mandate, and I've heard that question now a few times.
Yeah, especially because they seem to respond to financial conditions, but only when markets go down, not when markets go up. And that has been a consistent theme over the past number of years.
It's going to be a really challenging meeting next week, especially because they only have the inflation print. That's it. They're data-dependent Fed. They only have inflation. But more so, what do they do in December if the shutdown is prolonged past today, 24 days?
What a week coming up next week. This week has all been about anticipation of next week. Massive tech earnings, Federal Reserve decision, and a meeting between the two leaders of the two largest economies on the planet. The President of the United States with the Chinese leader Xi Jinping. Coming up on Monday, full coverage of all of that with Elizabeth Economy of the Hoover Institution, Greg Peters of PGIM Fixed Income, Angelo Zeno of CFRA, Abby Yoder of JP Morgan Global Wealth. Before we go, a very special happy birthday to our executive producer, Amy. Have a wonderful birthday, Amy, and to all of you at home, have a wonderful weekend. Live from New York City this morning, good morning.